G'day expats, it's Brett Evans here from Atlas Wealth, just bringing everything online, and we'll get this show on the road very, very shortly. Just while we're doing this and just waiting for a few more people to join us, can I just get a just response from people just to confirm that they can see me on the screen? Not that it's a very good picture, but as I say, I've got a good head for radio. But if you can see me and also hear me, please. Fantastic. Okay, everyone's coming online there, which is great. We've just got people piling in at the moment. Just to give you a bit of feedback, right now this is actually going out to 52 countries. So we've had a lot of questions about why we're using GoToWebinar, and the honest answer, rather than Zoom or the other providers, and the honest answer is, you know, with the high traffic on Zoom at the moment, because of the everyone's loving the functionality there, it's not the most stable across all the countries we're going out to. So GoToWebinar is probably the legacy player in the game, and has the resources to make sure that this can get out there. So yeah, so thank you very much for, it's a little bit of an extra process in terms of signing in, but once you've signed into a GoToWebinar, you don't have to go through that same process again. The other thing too, just want to quickly point out, there's a lot of people who have really helped us get this up and going. And first of all, thank you very much for your patience with the problem last night. We've been absolutely flat out at the moment, as you can imagine. And with the when we're setting this up, we didn't realise there was a 100-person limit on that. So once we hit 100, my screen lit up like a Christmas tree with all the requests to join, and I couldn't actually change it once we'd started the session. So just want to say a massive thank you to everyone for your patience and rejoining us tonight. As I was saying before, there's a lot of people that do help us get these things together, a lot of organisations, but just want to make a special mention and a big shout out thanks to Lisa Melly from the Australian Business Council Dubai. She was on the phone to me straight away, both yesterday and today, and said, right, how do we get this going again? Obviously, because of the process, we have to get everyone to re-register, which is not the most simple of exercises given what we're going through right now. So just want to say a massive thanks to Lisa. And also to everyone else who did help us as well too. We're getting pretty close to having everyone joined in, so we'll kick it off in about 2 minutes' time. Also just want to say, my thoughts and prayers are going out to those who are really financially finding it tough at the moment. This has hit so many people in so many different ways. Every day I'm hearing different stories of people being affected in the most obtuse ways. And from our point of view, we're not going to paint a very rosy picture tonight. The experiences we're going through at the moment are certainly as frequent as Haley's Comet. And obviously we're based in Dubai, and I'll run through that in a sec. But as of in about half an hour's time, the streets will be down, closed down, and everything will be quiet as a mouse. So certainly do your part, folks. Stay inside, stay indoors, wash your hands, and a shower too. There's a good meme going around about making sure you do both. And we'll get this show on the road. So I think we're pretty much almost there with most people. So what I'll do is just start this. So I love audience feedback. I'm just going to go change this onto screen so everyone can see the presentation, and we'll get this show on the road. Okay. Just waiting for that to come up now. Okay, let me just change that. Okay, I'm just going to change my screens here because quite often, there we go. Okay, can everyone just confirm they're seeing the presentation on the screen there, please? Fantastic, guys. Thank you very much. So just as an introduction, obviously tonight, as you would be aware, we're talking about COVID-19, how it's going to affect Australian expats, how it's going to affect the economy in general, both domestically and internationally, and just some key points that we're making sure that everyone's aware of. In this webinar tonight, we've got both clients and Australian expats in general, so you might hear me use the terms interchangeably. For those clients who you've heard all of us talk about this ad nauseum, just bear with us as we explain some of the other concepts to everyone else. So just running through the screens here. Just give me 1 second. I'm just going to change where this is laid out so I can see what I'm talking about. Okay, rightio. So on to the first point here. where, as any financial services firm, we are by law required to give a bit of a disclaimer. And just to put this into a nutshell, long story short, what we're virtually saying here is everything you're learning here and hearing here is for informational purposes only and should not be construed as financial advice. You do need to speak to someone who is licensed, and I'll use that word because that's a very important word, and experienced in talking about these topics. Okay, so running on to who we are. Essentially, Atlas Wealth Management is the leading provider of Australian expat tax financial advice, and we've been proud to win a number of domestic and international awards for what we're doing. We're classified as a tax financial advisor with the Tax Practitioners Board in Australia. We've got clients in over 30 countries, all with some pretty amazing stories to tell, and all of our advisors are degree qualified and also to a number of postgraduate qualifications as well too. So we don't just talk the talk, we walk the walk when it comes to having the education and the experience to do what we do. Atlas Wealth Management has 2 offices, one in Australia and one in Dubai. So the Australian office pretty much covers the Asia Pacific region, and the Dubai office covers the Europe, Middle East and Africa region. And we hold licenses both with the Australian Securities Investment Commission and also regulated by the Dubai Financial Services Authority. So who are these 2 ugly roosters? Essentially that's myself and James Ridley, who's my colleague, business partner and close friend. James runs the Australian office and handles all of our Asia Pacific clients, and the ugly guy on the left is obviously myself, and I handle all clients in the Europe, Middle East and Africa region. So some of the topics we're going to talk about today, obviously the economy, currency, tax residency, superannuation investing and property investing, and the all-important Q&A at the end. Just while I do this, if you do have questions that come to mind, please feel free to start putting those in the questions box. And what we'll do is at the Q&A session at the end, we'll then start to run through those and provide an appropriate answer anyway for you guys. So just running through here. Okay, so the economy. Look, this one here, as you'll see by the numbers, they're pretty large. And certainly when it comes to determining, the economic effects, you won't find any fluffing around here from our point of view. We're going to give sort of the hard numbers and give you where we think things are going to land. Unfortunately, at the moment, everything's changing on an hourly and a daily basis. So these are numbers as of today. If we held the session tomorrow, the numbers might be different as well too. Okay, just getting comments on here. Someone can't see the slides. Can everyone see the slides? Okay, I'm not sure why you can't see the slides there, Nina. Just also too, what we'll be doing is when we do send out the presentation, what we're going to do is also provide a link to download the PDF of the slides as well too. So I can see some there can see it, some can't. I'm guessing it might be to do with whether you're logging in via a computer or an iPad. So just bear with us, guys. We'll get all the information to you as well. So right now about 80% of people saying they can see the slides and 20% can't see it. So I'm not sure what's happening there. Okay, so on to the economy. Look, this is a lot of debate. Is it too little, too late? Has the the Australian federal government done enough? So we thought we'd put these packages in perspective and compare it to our sort of, I guess, bellwether event most recently experienced, which is the GFC. So currently the government's stimulus package is up to $214 billion, which is equivalent to 10% of the Australian economy. Comparing that to the GFC, it was about 4.3% the size of the package. So what we're seeing right now is, excuse me, almost policy being made up on the fly. And you'll see when I refer to especially the super and the property section, how we're generalising because there's been no fine details that have come through yet, but I'll come through that shortly. More measures are being announced, and I dare say tomorrow we'll probably hear more on the property side, which I'll cover off in that section as well too. to give you an idea of the scale of this, within an hour of yesterday's announcement regarding those JobKeeper packages for businesses, 8,000 businesses had registered in the first hour. So it's certainly hitting a lot of Australians, and from our point of view, we're going to see more and more changes more and more announcements being sent through in the coming days and weeks. Big debate right now regarding recession versus depression. Look, I think it's a given, a high probability of a sharp recession. The big debate going on right now is we're going to see, we don't know the effects on the economy until after the fact, because obviously all the data is historical, but looking at the numbers, it's pretty safe to assume approximately 12% across the March and June quarters in terms of the economy shrinking. We believe that the depression will be avoided, and one of the reasons for that is based on the economic stimuluses that are being announced. If both Australian and international governments haven't been as aggressive in announcing their changes, then we could certainly see a depression coming out of it. But right now, I think it's safe to say that depression is off the cards. The big question is going to be is, are we going to see a V-shaped, a U-shaped, or an L-shaped recovery? And, us people working in finance, we love, sort of coming up with phrases, and virtually a V-shaped recovery is, the market falls or the economy falls and then bounces straight back out again. A U-shaped recovery is essentially the economy falls, we have a period of stagnation, then it recovers again. And then an L-shaped recovery is like the letter L, and that's more of a depression. So right now, we're more likened towards a U-shaped recovery, but it'd be great to have a V-shaped recovery as well too. Okay, so running on the international side. At the moment, government stimulus packages around the world, if we do see aggregating, right now they're running at about 3% of GDP. So looking at the numbers, it is quite light on, but obviously don't forget you get that bell end effect or the barbell effect in relation to some economies have announced more, so it's an averaging effect. Obviously the African countries, they won't have the spending power as, say, the European or the American economies as well too. So there's always that balancing effect, and as different economies go through different problems, we'll see more of an announcement regarding that. With respect to China, we are starting to see them reopening for business, and we're going to be looking at their data very closely to see how much of an effect that has had. There's always that circumspect aspect of, is the data that China's releasing factual or not? One of the best sources that we use is the Australian Bureau of Statistics and the ABS, and every month they release what's called the ABS chart pack. And for data nerds like ourselves, there's a lot of fascinating information in there, but one of the ones we love to watch is in relation to China. The ABS shows you their consumption of concrete, their consumption of electricity, and consumption of steel. So, that's hard data that's very hard to fudge and gives us an idea on economic activity. With respect to the US, right now they're running at 9.5% of their GDP with, in relation to their stimulus package. Right now it took 8 days for the Federal Reserve to go from, a quantitative easing package of 700 billion up to what they call QE infinity. And just for those out there who are unaware of what QE is, essentially what they're doing is they're going into the market, the financial markets, and buying everything they can. And what that does is obviously by that purchase, they're injecting capital in, and then at some point down the track, they'll unwind those books. Running through the scenario of what we're right now, obviously the US Feds don't have unlimited funds, but what they're trying to say is we're here to back it, trying to give the market confidence, and we will put as much money as we have to into the market. The term asset-backed securities facility is back after starring in the GFC, and what this is virtually a way to keep credit lines open and flowing. So, virtually what happens is companies that, provide debt facilities, car loans, student loans, and all those sort of things, they on-sell that debt to aggregators, and they're making sure that that's there so they can keep providing debt and keep those lines of business open. Okay, so let's run through some hard numbers in Oz, and unemployment's obviously a big consideration. So currently, as of the 29th of February 2020, we're sitting at 5.2%. The reason I say 5.2 currently, because I dare say every month that we see the numbers coming out, that number is going to jump quite dramatically. These numbers are released as part of that ABS chart pack, and we should see the new numbers being released on the probably 2nd or 3rd of April. Historical average of unemployment at 6.2%, and that's dating all the way back to 1978, and estimates of 11% by June, and then possibly recovering back to 8.8% in December. That number, and that estimate is changing on a daily basis, and we can sort of draw analogies based on how many people are applying for Centrelink benefits based on the feedback from Centrelink. But as I said, that number, it's amazing how in the past weekly data was great. Now we're sort of almost asking for hourly data because it is changing so quickly. We have seen in the press today they're talking about unemployment in the US up to 32%. Look, I don't think it's going to be the case. I do think that, certainly definitely in the double digits, maybe between 10 and 20%, all depending on sectors and also to geographical regions. If you might remember back to the GFC, we saw places of heavy industry and also to property-related locations were decimated, while other locations didn't feel the punch as much. So from our point of view, the sectors most affected will be the accommodation and food services, retails, arts and recreation, manufacturing, transport, warehousing, real estate and construction. So let's run through the next topic. Sorry, my voice is going here. I've been talking too much today, so just bear with me here. So currency, big debate right now for Australian expats, especially those who earn either US dollar or US dollar derivative type currencies like Hong Kong dollars, dirhams and those sort of things, because we're certainly seeing some very low levels at the moment. So let's run through our take on the currency market right now. What we're going to try and do is explain the currency market first to then explain our point, and we'll certainly cover off on some of those issues there. So to give you an idea, excuse me, to give you an idea on the FX market, daily turnover is approximately $6.6 trillion per day, and that's data. The most recent data I could find from the Bank of International Settlements. Right now, the US dollar accounts for about 88% of being on one side of all those trades. So US dollar is essentially the what's the best way to describe it? The safe house or the mothership for a lot of people who do deal on the currency side. As a comparison, the Australian dollar accounted for about 6.8%. So the US dollar, as you'll see in the next chart, is certainly the lion's share. And what we often see when the markets go through an experience like we're going through right now is it's almost like everyone hits the panic button and just goes straight back to the most widely held currency, which is the US dollar. As you can see on this chart here, right now 88% of all currency turnover involves the US dollar, and followed by the euro, the yen, the pound and the Australian dollar. So when people are, I guess, in a panic mode, certainly what we see is people just suddenly unwind all their positions, and I'm more talking from a corporate or an institutional level, because what they want to do is be able to hold and hoard as much cash as possible and try and negate any volatility. If everyone's rushing back to US dollars, then that's sort of the safe house, and that's what I was describing before about investors and corporates sort of running back to mama. So what we're seeing out of this is when especially early March, when we really started to see everything unwinding, both in the bond, equity and fixed interest markets, the major investors essentially have a mandate in terms of what they're to do when certain volatility and certain experiences are occurring in the market. And virtually that is just close everything down that is considered high risk or emerging and go back to developed currencies and countries. And that's what we saw when people were sitting on quite highly leveraged positions going into January and February. There was a lot of debt around, and due to that debt, obviously people wanted to close it out, but we have what's called a margin call. And what we see is virtually selling across the board, and I was sitting here one night watching the television, and when you see both equity, fixed interest, even commodities like gold, everything was down for the night, you know that people are just taking money off the table. So this next chart gives you an idea of who the players are in the currency game. So what this is here is virtually a turnover based on the counterparty, and the counterparty is just virtually the person sitting on the other side of the desk. So as you can see there, we've got reporting dealers, we've got non-financial customers, other financial institutions, and then you've got your non-reporting banks, institutional investors, and hedge funds. And as you can see there, the hedge funds, the institutional investors, and other financial institutions make up a very big part of that currency pool. And they're there not because they're buying widgets from China and exporting or importing. They're there because they're hedging, they're also investing, they're making bets on which way the currency is going to go. So when you do see a market like we do, we see everything sold off across the board. And so a lot of the questions coming from our clients right now is, well, how does the Australian dollar fit into this? Is there more downside? And what's the next step? So really, the recent rally to us will be short-lived. You know, right now we saw everyone run to the US dollar. The US Federal Reserve expanded their supply of US dollars in the market through the quantitative easing, and now we've seen the Australian dollar sort of, I guess, settle down and level out. But we are concerned about the Australian dollar is considered a trade currency, not a safe house currency. So obviously with our exports and with a lot of those things that go with, you know, Australia Inc., Australian dollars are bought and sold all the time. You know, as an example, iron ore exports to China. Obviously the Chinese are buying Australian dollars to pay for those exports from Rio Tinto, BHP, and Fortescue. Now, what I said before about, you know, being the downside risk is, you know, if those trade numbers that come out from China aren't as good or aren't as big as the market is priced in right now, we could see further numbers coming down. You know, China came out today and said, okay, we're going to change the way we're reporting our numbers. This time we promised that we're going to do it right. Once again, we don't really sort of look at those numbers. For us, we look at the hard data to determine whether their consumption levels have picked back up again, and that's both mainly consumption of Australian exports, and that will give us an idea of where the Australian dollar is going. But to me, having been through my fair share of events, you know, I don't think we're going to be able to support 61. But in saying that, as you can see in that previous chart, there are a lot of punters in there who are sort of, you know, trying to make a bet as to if it's going to go up or down, and that'll be also a big dictator as well too. Also, if we do get more numbers out from the respective governments that are, you know, not as favourable as we hope, then we could see the market take a risk-off approach, and that's that rush back to US dollars. So what you're going to see in the currency markets is a lot of volatility, and don't certainly expect to see any reduction in that volatility probably for the next 3 to 6 weeks, to be honest with you. The currency markets, like with the equity markets, they don't actually wait for an event to occur for it to change. They will try and price things in advance. So what you're going to see is a lot of quantitative analysis going on in the background, trying to scrape as much data again to form a view of where everything should go, and then people will start virtually placing their bets as we lead up to it. And what we're going to see is this seesawing effect going on with the currency market as people trying to determine how bad the economy is affected, both in Australia and, from our point of view, China, and also to, you know, where's the next step. So just want to put up on the chart here, this is as of yesterday's data. You know, obviously we see from the 18th of March there, which is the top graph, sorry, the 16th of March going straight through, we saw the currency get down below the 56 level, but then things started to pick up again and started to power on, and obviously right now we're sitting in the 61s. But when you do look at the last 1 year, you can see we've been on a bit of a slippery slope even before the whole coronavirus took hold in March. So certainly things weren't looking great as it is, but now with interest rates back to where they are, you know, interest rate differentials are going to affect the currency, but right now we think more the economic numbers both coming out of Australia and also to China are going to affect us. And given the size of the stimulus package that was announced, big question is, will Standard & Poor's and Moody's, or Standard & Poor's more so, maintain their gold-plated AAA credit rating with Australia. If we do, and that's, they are watching it, they're nervous that the Australian government is spending too much, and if we do see obviously a change in that credit rating, it'll have a multitude of effects. Mainly the currency will come off, but also it'll certainly affect how cheaply the Australian government and also the Australian banks can borrow money in the offshore market. So running through on to the next one, tax residency. This has been a big one. I'm involved in this myself. My wife and daughters are stuck back in Australia at the moment, so we've been watching this closely, and it was great to see that the ATO actually were quite practical and quite pragmatic in getting this information out there. So what they virtually said were individuals who are in Australia temporarily for some weeks or months due to the lockdown will not become an Australian resident, provided that they usually live overseas and that you intend to return there as soon as they're available. Now, it's always nice to have finite numbers, how long, 2 weeks, 2 months, 6 months. The ATO is updating this regularly, and certainly as we see more information coming along, we'll be putting that out in all of our usual website and social media channels, so which I'll provide the links at the end. But as at the moment, Australian non-tax residents who are stuck in Australia, certainly there's a lot of families who are stuck in Australia because they can't get back into the UAE, for example, because there's a ban on resident visas. You don't have anything to worry about at the moment, but we'll watch that one closely. The other one too is those who are stuck in Australia, but they're actually working for their companies overseas while they're back in Australia, which a lot of companies would expect people to bring out the laptop and continue that process. So where we are right now, paid leave, if an Australian expat receives paid leave, such as annual leave, they don't consider this as an Australian income and would not be assessable in Australia, and as well as remote working. So they accept that working in Australia for less than 3 months will not result in them being assessed for Australian tax. If we look at the chronology, call it March, 20th of March is when they made this announcement, so we've got until the 20th of June, but they are going to watch this closely, and hopefully by then we'll start to see borders start to open up a bit and people are able to get back to their countries of residence and domicile. So next one as well, superannuation. This has been receiving a lot of attention, so we'll hopefully go through here and just be able to provide a bit more clarity. When the government announced the early access to super, bearing in mind that they are making a lot of policy changes incredibly quickly with not a lot of attention to detail. So the first question was, can Australian non-residents for tax purposes access their super? Well, there are criteria, generally speaking, that the ATO and the federal government has released. The first requirement is, are you unemployed? Are you eligible to receive a job seeker payment, youth allowance, and so on? And on or after the 1st of January, you're made redundant, your working hours were reduced, or you're sole trader and your business has been suspended, or there's been a reduction in 20% of turnover. The issue with us is it's, as you can see, they're all or. So people might say, well, I'm overseas and I'll be made unemployed, or I was overseas and was made redundant after the 1st of January 2020. There is nothing in there and there's no legislation to work from because Parliament is closed right now. So we don't know exactly whether an Australian non-resident for tax purposes is able to access their super. The federal government has confirmed that the Australian Tax Office will be wholly responsible for identifying and verifying hardship with the early release of superannuation candidates. So I guess the first question you have to ask yourself is, do you want the ATO trawling through your details to fulfill that requirement? And second of all, some people will say yes because they're desperate. From our point of view, we know we're going to hear more information on this in coming weeks. At the moment, no one can actually access this. You have to go through the MyGov website, which opens on the 20th of April to start this process. And essentially what it means is you can draw down $10,000 from your super account before the 30th of June, and you can draw down another $10,000 after the 1st of July. This one is an evolving piece, and on the outset, I would say Australian expats would not be able to access this, but we haven't seen the devil in the detail yet, and as soon as we do, we'll definitely make everyone aware of what's going on. We do have a number of concerns regarding super, and probably our biggest one right now is the industry funds. So the industry funds have, I guess, relied on a very clever marketing campaign combined with some regulatory changes, which has virtually ballooned their balance sheets in terms of how they're managing money. Because they were receiving so much money by way of the superannuation guarantee, the 9.5% that was been going into their coffers every time, they decided to go out and started to invest in more unlisted assets. Unlisted means it's not traded on any market and it's not immediately liquid. And by doing this, they lauded this as a great way of diversifying and so on and so forth. But during the GFC, this was a liability for them, and there were a number of funds that could not pay out members' contributions in the requested time, and it looks like we're going through that same process again. So the run on the funds to withdraw $20,000 is, I said there may, but we know it is now, is creating a liquidity crisis. Numbers and guesstimates at the moment, there'll be about $50 billion Australian pulled out of the Australian super sector. And what you're going to understand as a superannuation fund, they have to hold on so much cash to maintain that ability to pay out during regular markets in a regular interval. But the problem they've got is now you've got super funds that have their members are highly correlated to certain sectors. Host Plus is one, for example. Rest is another. So Host Plus with hospitality, Rest with retail. You may see more of those funds members drawing down on this, which is going to exacerbate and create more problems with their ability to fund that. Now, with most super funds, everything is through a liquid market, so the normal view would be as investors or members start to request redemptions, they sell down the market, create the cash and so forth. Now the problem that the industry funds have got is they're holding unlisted assets which you just can't turn over tomorrow. So they've really got a difficult situation to find. They went cap in hand to the government to say, can the Reserve Bank please bail us out? The government said no. Because virtually the trustees of these industry funds have got themselves in this situation. They said, you have to get yourself out of this situation. The other problem that we find with the industry funds is, yes, they've had a very good performance, but that's the reason for that is they've skewed the numbers. So when you look at what should be a balanced portfolio, normally it should be along the lines of 60% growth assets, 40% in income assets. The industry funds, and not everyone, but most of them, were running 80-20. Which is more of a high growth type of balance. Now that's great when we've had the bull market post the GFC and the returns are all going up. But now those people who risk profiled as a balanced investor were essentially investing as a growth investor and should not have been in the past. And it's like that great thing, people never complain when things are going up, but right now you are going to see a lot of pain going through. So that is another concern we're going to see, and the industry funds aren't the most transparent of businesses. They don't actually provide a lot of information in terms of their true performance and also their underlying costs. So I think we're going to see a lot of changes going on there. Also too, and I'll show you an article on the next page, which was written by Robert Gottliebson, who's a very well-respected commentator in the finance game. A lot of the industry funds got caught hedging their currency in the wrong way, which resulted them in having to pay out some very large checks. So that's going to come off their balance sheet as well. The other one I want to point out too, for those with Q Super, they have retained the pandemic exclusion in their insurance that is attaching to super. So there's a 30-day exclusion period which applies to additional cover taken out by members after the March 18 and any new members who join by choice after that date. So those people who've suddenly just gone in there post that 18th of March period, just be aware that if you do develop COVID-19, you may not be able to use your insurance inside super to claim on that. So this is the article I was referring to, and what we'll do here is makes it very difficult for everyone to read, but when we send out a copy of the video, I'm also going to provide a URL link of this article. I think it's a very important article that everyone reads, and it's not too financy, so I think everyone will get the gist of it, but you'll see virtually what they're doing in the background to try and plug this gap, because if $50 billion is going to leave the super industry, that is going to affect the industry funds a lot. So coming on to our next topic, which is obviously property, certainly a way of life and a hobby for most Australians. So From an expat's point of view, we've been well documented on our views of property from an expat's point of view. But we'll just run through some of the key issues that we're talking to clients at the moment, and just want to make everyone aware of as we go. So here we go. So main residence exemption. Yep, we've been talking about it since the 8th of May 2017 when this is first announced. We did our best to try and get out there and did what we could. Us and 4 other parties were very vocal and active, and we were able to stymie the first original set of legislation in the Senate. So it passed the lower house, got to the Senate, and it was thrown out. That was just before the election last year, and then in August last year they came back with a couple of minor changes that really only affected 5% of people, and the other 95%, for them it was no change, and unfortunately it did go through. It received royal assent on the 12th of December 2019. So really expats have only had the better part of 3 months to act on this, which we always argued was ridiculous. Now with open houses and auctions banned, and also we're hearing stories too from clients, they've had tenants who've tested positive for COVID-19. They obviously can't do a private showing, and they can't even ask the tenant to leave while they're going through quarantine. So we're seeing a lot of dramas. We've written to 7 MPs and senators. We've written to the Treasurer, the Assistant Treasurer, the Shadow Treasurer, the Assistant Shadow Treasurer, the Minister for Financial Services, and also two senators. And if you would like to see those letters, more than happy to show you the points we're trying to argue with them. We don't think we'll get much of a voice. We are going to keep trying to bang on this drum to try and get an extension. Virtually what we want is the government to announce that there'll be a 6 to 12-month extension to the 30 June 2020 deadline. Canberra is shut. Obviously, Parliament's shut at the moment, so they can't pass any legislation through, but the Treasurer can make an announcement to say that this will be extended, and then when Parliament resits in August, then they can pass that legislation. So we're just hoping a bit of common sense will prevail, but as we say to clients, don't hold your breath. We're doing what we can, but we don't like our chances, but we're going to try anyway. If you must act, do what you can in terms of completing any sales that are currently pending. Certainly if you can sell before 30 June, even with all these impediments, then, and that's what your intention is, then please go ahead unless you hear from us otherwise. But we're certainly trying our best in the background. Okay, so this is another one that's affecting a lot of our clients as well too. And there's a lot of debate regarding, what you can and can't do in terms of, as a landlord, if your tenant can't pay or is tested positive for COVID-19. So the Prime Minister has stated that landlords and tenants need to have negotiations in relation to rent relief. That needs to be a dialogue back and forth, and you need to show evidence of some sort of compromise. They haven't announced the details of what that looks like, but obviously we're guessing that some documentary evidence of what's going on. The government is going to announce something in the coming days regarding property. So if you are having conversations with your tenants, best to be on the front foot and trying to be shown to be conciliatory, because if you're not, the government has said that you would not receive any tax relief that the government is currently formulating and is going to announce in the coming days. So it is a difficult time. He was very vocal in saying that everyone has to wear their fair share, and he specifically stated landlords with respect to this. They are saying there's going to be significant federal and state tax breaks in return for waiving or reducing rents. So, I think if you haven't started that conversation, it might be wise to start that, and certainly we'll keep everyone informed on our website and our social media channels in the coming days with any further information. The other one we just want to touch on, and this has sort of been brought to our attention by a number of clients and also people we work with, about, there's a lot of stuff on social media about property being immune from all this, and it's the only way to go and everything. So the property sector requires capital to keep the machine working. If people can't borrow money, people can't buy property. The rising unemployment and slowing economy are expected to make lending conditions tougher, and we're already seeing that with a lot of the banks. Some lenders are banning new loans for employees in what they call restricted opening industries like pubs, cinemas, restaurants, etc. And a lot of other sectors are due to follow. What we're seeing at the moment is there's an incredible amount of excess stock that is or about to hit the market. These are completed properties, and we've seen the property spruikers out there in overdrive. So give you an idea, when you're talking to someone, just always in the back of your mind question what this person's motivation is, because we are hearing of commissions of up to 10% being offered to get rid of these properties. So what you don't want to be is the poor sap who pays for a property 10% higher than what it was worth, because obviously they're willing to pay 10% commissions, but also too, property is always the last asset to start to fall in value, because it's not as liquid, and also people don't have a ticker tape above their property, so they don't see the value falling as much, and it does take a while for the cogs to start to kick in. But from our point of view, just be wary, property hasn't adjusted yet, and it will. So I'll just start to show you some numbers here, and not so much for Queensland and Perth, but certainly in the southern states, auction clearance rates are always considered and held up by agents and the property industry as the bellwether of the health of the market. And these are the numbers from this weekend's auctions. So essentially, Sydney clearance rate of 37.3%, Melbourne 35.3%, with a national average of 35.3%. Bearing in mind that stage 2 restrictions were only announced last week. So it's going to be interesting to see what this weekend's numbers are. And just to give you a bit of a benchmark, the last time Sydney and Melbourne hit the lowest point was in July 1989, when the Reserve Bank hiked the cash rate to 17%. So both cities saw clearance rates plunge to 33%. I would not be surprised with the current restrictions in place if we see clearance rates down to probably 15 to 20%. Yes, there will be some agents out there who will use online auctions and virtual walkthrough of properties, but my concern is it's not the person selling, it's actually the person on the other side. A, can they get a loan? And B, can they, do they have the appetite to buy a property? A lot of people sort of go into a bit of a hibernation when these events occur, and you may see that buyer demand dry up very quickly. Those who've been following us for a while know this is one of my favourite charts, because this to me is, I guess, the temperature of how the property, the health check for homeowners, as I call it. And this is data that comes out from the ABS. This is part of their monthly chart pack. And what we're looking at here is virtually their non-performing assets, which in layman's terms is essentially defaults. And if we look there, it's more so the right-hand side I want you to look at. So as you can see, we going through, and then just take this into account as well too, this data is as of the 27th of February. So it hasn't even taken in the last month as well. So that bottom one there, housing at 49%. As we can see, from a default point of view, we saw a big spike in 2009. Surprise, surprise, that is the GFC. Right now, we're at 1%. Now, the biggest concern with that is this is before all this really started to bite down. This is before work from home. This is before businesses started to shutter up. That number is going to climb incredibly rapidly, and we're going to see a lot higher numbers as the weeks and months come. So right now, Australian consumers, too many lattes and smashed avocado on toast, as the joke goes, but it's true. People were living with too much debt, and the cost of living was going up, wage growth was going down. So they couldn't afford to live the way they were, and this is before COVID-19. So that number there is going to jump rapidly, and certainly, once we see the new numbers, which will come out, as I said, the next couple of days, that'll be the bellwether of, how the last, 30 days has gone as well too. So let's touch on the topic of investing, and I'm going to touch on from 2 points. And this is, the first point's got to be obviously property, and the second point's going to be investing in a investment portfolio. So generally speaking, why should you invest in Australia? Look, you get the currency advantage. The dollar's at 61. Will it be here down the track? Will it be, at 61 or 50? It's certainly got to flop around for the next, so 3, 6, 9 and 12 months. But if your view is to return back to Australia in, say, 5 years' time, then will the dollar be at 61? The long-term average is 78.7 if you look over the last 10 years. So you'd think not, but then again, we are in uncertain times. So from our point of view, we're saying to clients, look, your purchasing power in Australia has gone up remarkably, and you just need to then allocate that money appropriately whether it's putting money into an offset account, whether it is paying off some debt, whether it is buying another property. We're not recommending clients do that at the moment because obviously we think property is going to fall quite remarkably. Currency risk, we talk about, there's one constant, bearing in mind we've got clients in 30 countries, there's one constant amongst all our clients, no matter what profession they're in or their circumstances are, that change is a constant. And what we always talk about is you need to try and simplify your financial affair, and we always talk about you need to accumulate your wealth in the country you would tend to return to or retire to. And moments like this are a classic case in point. And in 5 years' time, do you know where the dollar's going to be? Is your purchasing power going to be higher or lower? Murphy's Law always says that when it's time to go back to Australia, if that's where you're going to return to, that the currency will go against you the day before that you go to move that money. So take Mr. Murphy out of it. If you're accruing money in Australian dollars in your expat journey, then what will happen is when it comes time to leave, your money's there waiting for you. You're not basing your relocation based on what's happening with the currency. Classic case in point was two clients of ours, both families in the UK. They were about to repatriate back to Australia. And 2 days after a key event called the Brexit vote, they had to put that plan on hold for 2 years because the pound fell 15%. So they were holding all their wealth in sterling, were about to transfer everything back to Australia, and had a massive problem because they either took a financial haircut with that relocation, or they stuck it out, which is what they end up doing. Locking in the exchange rate, like I said before, you never get advantage of a price until you actually execute and follow through on the transaction. So it's all great to say, yeah, I'll transfer money at 61, but unless you actually do it, you're not getting the benefit. Okay, so what I want to talk about here is just with setting up investment accounts. And just to give everyone a bit of a tax 101, when you're investing in assets in Australia, you have what's called taxable Australian property, house, apartment, mining lease, farm, anything that's physical and you can kick. And then you have non-taxable Australian property, shares, managed funds, ETFs and LICs. When it comes to the property side, as a non-resident for tax purposes, you continue to accrue a capital gains tax liability at the non-resident marginal tax rate on all property while you're overseas, and you do not get benefit of the 50% capital gains discount for that period. Also too, on any positive cash flow that is coming out of that property, if you are positively geared, you will pay 32.5% of any positive cash flow to the Australian Tax Office. As opposed to non-taxable Australian property, shares, managed funds, ETFs and LICs, there's little to no income tax. Now, to explain that, essentially when you buy a BHP, for example, a BHP will pay you a dividend, and before you receive that dividend, the share registry will look at your registration details to say, Mr. Smith, you are based in Dubai. Dubai does not have a double taxation agreement with Australia, therefore we withdraw 30% and then pay you the 70% difference. Where you can reduce that tax liability is if that share or if that dividend being paid to you has attached what's called a franking credit. Now, a franking credit is virtually tax paid on your behalf by the government when they pay their corporate tax. So when the share registry goes to pay the dividend to you, they'll first look at your address to see where you're from, and the second thing they'll do is look to see if there's a franking credit attached. And in that case, they'll net the two off, and BHP, 100% of the BHP dividend will be paid through to you with no withholding tax. For those clients who are in a country with a DTA like a Singapore or a United States, those countries, the withholding rate's only 15%, but you still have the 30% franking credit attached. And before anyone asks, no, you can't get access to the unused franking credits, unfortunately. With respect to capital gains tax, non-taxable Australian properties do not accrue capital gains tax while you're a non-resident, and I'll show you a chart on the next slide to give you more of a visual aspect as to how this works. But essentially, if you bought a share for $1 today, and while you're overseas, it goes to $2 and you sell it, then as far as the ATO is concerned, you have no tax to pay. And that is an incentive there to encourage the investing world to invest in Australia. It's not just a specific expat tax rule that the Canberra can change. It's part of a larger framework that encourages the Morningstars, the Templetons, the BlackRocks of the world to invest money into the Australian market. The other benefit too on investment portfolio is no tax returns. So non-taxable Australian property is what's called taxed at source. So before you receive the dividend, if there is any non-resident withholding tax to be deducted, they deduct it and you get paid the net. As opposed to with a property, the tenant pays you the money and then you turn around and have to declare that to the ATO. So that's where it's quite different, and that's one of the reasons why you don't need to complete a tax return if you're just holding an Australian share portfolio. So this is I guess the graphical representation of what I was saying before about how these different scenarios work. So while you're in Australia, as you can see here, you accrue, it is taxable. But for the period that you're overseas, you're not accruing any capital gains tax in that period. And then once you come back into Australia, you then continue to accrue a tax liability. It depends on the client's circumstances. Some clients, they buy a portfolio just after moved overseas, and then when they go back to Australia, they liquidate that portfolio, and then sometimes take that money and then recycle it and pay off their house debt, and then they've got a house with no debt on it. Some people actually continue to accrue or continue to invest in the same portfolio. Others will liquidate the portfolio, crystallize all the gains without any tax, and then put it into super. So whatever you do while you're away from an investing framework, you need to make sure it's liquid and it's flexible enough to adjust with your circumstances. So we've been well versed, and everyone would have heard our views and predications on insurance bonds, insurance schemes, and all those sort of things. Which locked in for 10 years. That's time for another seminar, but this is the reason why we talk about having that ability to be able to pivot quickly if your circumstances change. There's a lot of people who will have to relocate back to Australia, with no planning because they've lost their job or their visa's affected by what's going on with COVID-19. So it's times like this that really show you, what are the most tried and proven paths and other ones that are more so fads. So looking here, this is what we call the volatility index, and essentially the volatility index is a measure of an investor's risk appetite or nervousness. So as we can see here, the volatility index, for the last, call it 12 months, has been quite stable, and then we saw a massive peak up into the 50 range, in early March. So this is actually a very effective tool that we use all the time to determine when's an appropriate time to come in and out, because obviously when we do see a reduction in the VIX, that means investors' appetites are increasing and they're coming back into the market. And in the next chart here, I'll just run through a comparison. So what I've done there is I've overlaid the top chart is the ASX 200 index going back to 2009, which is obviously the GFC, and the bottom one is the ASX 200 VIX index. So as you can see, it's diametrically opposed to the way that the market's performing. But what it does do, it gives us almost a read on the temperature of investors in the market, and we can determine, is that risk or is that concern in the market increasing or decreasing. So it's a nice graphical representation. As you can see here, the VIX does drop back very quickly once investors start to get their handles on things, and I'll run through in the next slide, our take on the markets at the moment. But certainly from a way to monitor the market, if you are looking to get in, it is a very, very effective tool in terms of just getting a bellwether in terms of, is now the time or should I hold off? So the next one here is, this is virtually our take on the markets. We think, a sawtooth pattern of anxiety relief is likely to persist for another few weeks as the market is coming to terms with what's going on. Just to give you an idea, the market does have a personality of its own, and it might sound strange to describe it like that, but essentially the market wants to always price in what's occurring now and the future effects in the next 6, 9, 12 and 24 months. At the moment, leading up until this week, the market has not been able to price in what this economic effect is going to be across the broader market. So that's why we've seen this sort of seesaw effect as people say, okay, is the market oversold or is it undersold? At the moment, and this has always been the case for any market, whether it's currency, commodity or equity, the market always overshoots in one direction and undershoots in the other. And we saw the overshoot back in January and February, when obviously the 20th of January is when Wuhan really came out and said we've got a problem here. and when the market came back, and then, you know, like a sort of drunken sailor, up it went again on the back of, you know, sort of smokes and dreams. So that's a great example of a market overshooting on the upside. What we're seeing right now is the market overshooting on the downside, and you've got a couple of situations going on here. You have, you know, margin calls occurring, and the margin call is essentially when you take leverage on a equity position and the value of your asset falls, but obviously your debt doesn't fall. So as it gets closer to your loan amount, whoever's providing you with that debt is going to ask for money to put in. And guess what? You're going to either sell stock to put that money in, or you're going to pull it from somewhere else. And that's why we talk about this global margin call that occurred through the month of March. Now what we're starting to get back to now, as opposed to a liquidation phase, we're looking at more of a settling phase as the market is becoming more rational and it's getting its head around, okay, rightio, you know, is this country's curve flattening? You know, who shut down, what size of economic stimulus package is going on? Bearing in mind, and always take this into consideration, the market always wants to go up. So the market won't wait, like I said before with the currency, the market won't wait for an event to occur in order for it to turn around. It'll try and anticipate it. So by the time that it's occurred, it's old news and off we go. So, you know, what we said right now, the key risks around investing is certainly the size, the earnings impact on the individual companies. We are seeing on a daily basis companies come out with guidance and updating the market in terms of how it is affecting them. The impact of dividends, and I'll cover off on a key point on the next slide, that, you know, dividends are great, but you just need to be careful of a couple of things. And lastly, the scale of the capital raisings. And capital raising is virtually a company going out to the market to say, look, guys, you know, we need some more money to plug this gap, and shareholders will buy shares at a discounted price in order for that company to raise that cash. We saw Cochlear, the hearing implant manufacturer, last week go to the market and raise $880 million Australian just to plug some gaps, because the key risk that they're experiencing right now is obviously with the hearing implants, that's an elective surgery, and all hospitals have put off indefinitely all elective surgeries. So even though the Australian dollar where it is right now would help them with their exports, they can't actually export it because no one's actually buying them, because all the hospitals are full and committed to COVID-19 patients, and everything else has been pushed by the wayside. Like I said before, I'm a bit of a data nerd, so when it comes to, you know, looking at numbers, we can always look to the past to get an idea of you know, how the markets look, you know, 6, 9, 12, 24 and so on months down the track. And from our point of view, well, we've gone back to data, back to the 1900s, and this gives you an idea of a bear market, which is a fall of 20%, and then where it was after 12 months, and the percentage gain in the first 12 months after it's reached that low. So still the worst one. You know, right now we're looking at 29th of August, sorry, looking at June 14 to December 16. That was a 30-month bear market, 22% fall. Percentage change after 12 months, after falling 20%. It was actually up 11, and the gain in the first was up 10. So I won't read out all those ones, but it just gives you a rough idea. In 2014, 2016, obviously there were some big ones. If you look in 1937 to 1942, that was a 61-month bear market, 32% fall, and 7% change after 12 months after falling 20%, but then 12 months after, up another 30%. So we do see quite a lot of volatility. This is not new to the market. The way it's happening is different. The speed it's happening, and you can thank, you know, a very digital and connected world. You know, you look at those periods, you know, we're looking at 30 months, 23 months, 61 months. In the experience we're going through right now, it was 1 month. So, you know, everything is sped up, which makes it feel more out of control. But along with data becomes that quantitative ability to process that data quicker, whereas I dare say back in the 1900s, you know, there would have been sitting around some very rudimentary machines to try and calculate things. So for those people who are looking at getting the market for the first time, this is some of our key tips. From our point of view, you know, we do this on a daily basis, but, you know, those who want to go it alone, this is what we, you know, think investors should really be concerned about. Number one is account setup. We are constantly seeing people trying to, you know, I'll take a step back. Discount brokers in Australia have virtually almost shut up shop to allowing Australian expats to invest on their platform as a non-resident. People have been, I guess, trying to be a bit clever, and they've been using their parents, siblings, friends' address on those account setup processes. But this creates a massive compliance issue. And the reason being is when you set up an account to hold a equity portfolio, obviously on that account is a foreign address. And like I said before, when the share registries go to pay your dividend, they will determine whether any non-resident withholding tax needs to be deducted and then pay it accordingly. If you are using your parents, siblings, friends' address to do this, they're going to think that that account is an Australian tax resident account. And what it's going to mean is, you might open the doors up for the ATO to argue the point that you're acting like an Australian resident for tax purposes. It is a low bow, but we've seen, long bows, but we've seen the ATO go even longer than that. But more so important, the applicable amount of tax is not being deducted. So what it means is essentially you're not declaring or paying the non-resident withholding tax that you should be, because it's not happening automatically. So if you are holding any investments that are, don't have any franking credits, then 15 or 30% should be taken out of those dividends before they've been paid to you. If you do use a local Australian address and your account is classified as a local account, therefore that 15 to 30% is not being deducted out of that, and it could create a big issue down the track. For those going in, for the first time, start slow and watch for head fake rallies and dead cat bounces. So once again, the industry likes to think up some funny names. A head fake rally, head fake is virtually best way to describe it. A lot of sports, you use a head fake, you might run in one direction and then to confuse your opponent and then quickly change the other direction. So I won't do it on the screen because I look like a fool, but essentially you throw your head one direction and go the other direction. That's what we're experiencing right now, along with dead cat bounces. Essentially, a dead cat bounce is when you see the market fall very rapidly, you have a brief reprieve, and then falls back down again. So we think we haven't reached the bottom yet, but just if you are coming in for the first time, you might want to sort of ease into it. We wouldn't be saying to clients, especially, that's for sure, to go in with a whole bunch of cash at the moment, because you really are throwing a dart at a moving train. You're not exactly sure where you're going to hit in the line. So, but just remember, you don't know you've hit the bottom until we're past it. So everything is historical when it comes to determining that chronology. And just you need to take your time. Don't try and pick the bottom. There's a funny analogy that we use with our clients, which is quite dirty, but I won't say it. But essentially, it's picking bottoms. So don't try and pick the bottom. Just find a level that you're happy with at a price you're happy with, and then take that long-term view. Last thing, watch out for the yield traps. Yield trap is essentially when you have a company that's declared a dividend and the share price falls very quickly. So the way you work out a dividend yield is you divide the dividend by the share price. And most Australian stocks are around about, the average for the ASX 200 is about 4.2%. As the equity values have fallen, but the dividends haven't been amended yet, these dividends will go racing up. And it's going to appear like suddenly you can buy all these amazing stocks with double-digit dividend yields. But that's because the companies haven't come out and downgraded their dividends or completely suspended it. So dividend yield trap is always a bit of a catch for a lot of new players, because they'll go through and they'll buy something just based on the dividend without knowing what's going to happen the next 6, 9 or 12 months. Last one is to show you here, which is sort of more of a discussion point, from a collateral damage point of view, and this is what we're seeing playing out on a daily basis. SPC, everyone knows the fruit and the baked beans people. Leading producer of fruit and baked beans and spaghetti is running out of fruit and tomatoes due to panic buying. So this is a company that's obviously a stalwart of Australia, and right now they've got massive supply chain issues. So this is the sort of stuff we're starting to see play out. Deloitte, one of the big 4 accounting firms, they're actually going to shut down their whole operations for a week and force everyone to take leave. So their biggest concern is obviously billable hours and all those sort of things, and they're just trying to build up a cash reserve there as much as possible. And the last one is the Shaver Shop. A lot of Australian expats who've been overseas for a while may not know of them, but essentially they run 120 plus retail stores in Australia, and they sell beard trimmers, electric toothbrushes, hair dryers, and so on and so forth with razors. Guess what? Everyone's working from home and no one's shaving. So right now they're having a lot of problems. So there are some very niche scenarios that are playing out, and I'll just sort of put it up there for a bit of the by the by. So what we'll do is we'll run this across next to the famous Q&A section. So I'll just look here and see how many thousands of questions we've got and just start to run through that. So bear with me, guys. I'm just going to bring this up on the screen here. Okay, so I'll start from the beginning. First in, first best dressed. Okay. So question here from Greg. My concern relates to foot soldiers of hospitality, cooks, chefs, waiters, kitchen assistants, and how the government powers plan to support these unemployed. Completely agree. To me, we're up to sort of stage 3 of the packages. I could see this going to stage 5. As more and more coal-face data on the ground is coming out, you'd have to say that to me, it's going to become more and more evident of the real areas that are in the pain points. There is going to be a lot of data that's going to come out that shows where the bushfires are, and given the government's actions recently, and to give you an idea, as a good analogy, back in 2008, 2009, when the Lehman Brothers collapsed, it took the US Fed 3 months to cut rates back to 0, whereas they did it in 2 weeks. So as you can see here, the GFC was almost like a warm-up event for this in some weird ways. So certainly, from that point of view, there are a lot of people out there. I think teachers as well here in the United Arab Emirates. It was announced that essentially online learning, which has been going on since the 22nd of March, is going to extend to the end of June. So massive shout out to the teachers who had to completely adapt and change their learning frameworks, and certainly they're doing an amazing job. So well done to all the teachers out there. But medical staff, there's so many people who you don't even think of who are on the front line, and I really sincerely hope that the government's just get in there, support them, and pass on our thanks. Certainly from a financial aspect as well too. Question from Sandra, will you make the presentation available to us after? Yep, definitely will. I'll be sending out, when we send out the email with a copy of the recording, we'll also send out 2 URLs. One will be the actual PDF for the presentation, and the second one will be that the Australian article that Robert Gottliebson sent out as well too. So, okay, so running on to the next one, question here from Christopher. If I'm an Australian resident for tax purposes living in Poland and purchase shares, are those considered Australian assets, Polish assets, or both? Good question. So from the Australian Tax Office point of view, they are still treated, and you're still no different to if someone from Sydney or Brisbane were to buy some BHP. So from an ATO's point of view, you will need to still consider those as Australian assets, and it will be taxed accordingly. So you will continue to accrue capital gains tax, but you will get the 50% capital gains discount for assets held longer than 12 months. In relation to Poland, to be honest with you, we've only got a couple of Polish clients and clients based in Poland, and those clients are all considered non-residents. So really probably couldn't help you, I'm afraid. So, but from an Australian point of view, most definitely. Question here from Dick, will Australia be increasing its debt to China? Look, I guess the best question is, can beggars be choosers? It really depends on what the Australian government plans to do with respect to this funding and how we get out of this mess. Certainly a great initiative that was announced yesterday was from the Foreign Investment Review Board, that any international purchases of Australian assets will have to go through the FIRB all the way down to $1. So everything that's going to get bought that classifies or requests FIRB approval, everything will be reviewed by the FIRB. And what they want to make sure is that people aren't profiteering on assets in Australia that have been sold off or are depressed. So, I guess from that point of view, Dick, we've learned a good lesson out of this, and, I think watch that space. And question here from Christopher again, given the probability of a recession, when are shares likely to be decent investment vehicle? Now, later, are bonds a better bet? Look, to be honest with you, the bond market's a bit of a basket case at the moment. People are overpaying on the yields, so you might be jumping on into the party a bit late there. From an equity market point of view, look, at the moment, from an ASX level, you're buying things, sort of 25-30% cheaper than it was back in February. So some people will look at that and say, yeah, that's enough for me. For those who want to pay a bit more cautiously, they might start to ease in at the current levels and see how that market performs. And for others, they may, there's a great adage about don't catch a falling knife. They may want to see the bottom first and see that market rally before they come in. Just bearing in mind that when the market does rally off its lows, it is very savage and it's very quick and very large. So, you won't be able to buy 1% off the bottom after a turn. The turn's normally between 5, 10, 15 and 20% off its lows when it does happen in a very short amount of time. Okay, on to Ross. Did you see that the Hong Kong dollar peg is under pressure? Certainly did, Ross. I think a lot of currencies right now, the respective reserves for each one of those countries would be going through a lot of pain in trying to maintain those pegs. And, from our point of view, what we're seeing right now is a once in a generation, experience, certainly from an economic and a global perspective. As I said before, it's like Halley's Comet. These sort of things do not happen all the time, and sort of almost reminds me when I first started working in financial markets back in '97 through the Asian financial crisis with the Thai baht. There's going to be a lot of pain points we're just not aware of just yet, but more information will come out. And this is what I was saying before about equity markets. If we do see another couple of sort of whoops events in the coming weeks, then that will certainly shake up investors, and we could see further sell-offs. Okay, question here from Matthew. Do you have different strategies for those clients closer to retirement than your other clients? 100%. To us, there is no cookie-cutter sausage factory approach when it comes to investing. And also, it's not just the age of the client, but also too, it's their attitude to risk. We've got clients who are 25 who have the risk profile of an 80-year-old, and that's because they don't have a high risk appetite. Whereas we've got clients who are 80 who are investing like they're 20. So, certainly if you are getting close to retirement and you are going through those experiences, I'd like to sort of give you 2 practical examples of what to do and what not to do. So obviously being in this game through the GFC, unfortunately we saw a lot of retirees and pre-retirees go to cash in a panic. The problem with that is when the market did turn, and it did and always does, they were in cash, so they didn't get the benefit of the lift up. You should always, as you get close to retirement, be building up your cash reserves with at least 6 months worth of income requirements, and preferably more as you go into that retirement period. So the biggest thing that we're seeing at the moment is, Siri's gone there. The biggest thing we're seeing at the moment is, people are living longer. So the last thing you want to do if you're, say, 65 is go straight into a cash mode, because you have 30 years or 20, or depending on who you believe, but the way medical advancements are going, possibly 30 years of retirement to fund for. And the cost of living is not going down, but it may do with this event. But, it is a very big gamble to go into a very aggressive cash position after we've gone through this. Certainly if it was, this time last year, definitely, but not at the moment. I think from that point of view, you need to trade very carefully, but be wary of jumping out. But certainly from a retiree's point of view, yeah, you'd want to be holding less growth and more income assets. Okay, going on here to Estelle. Regarding super, would you recommend expats with industry super funds in Australia transferring existing super funds to a different super account? Probably more of a long-term fund protection question. Look, I mean, there are, very, very different reasons why you'd be in different funds. So industry super funds, yes, they're cheap, because the old saying, pay peanuts, get monkeys. So you do not get very little to any functionality with respect to an industry super fund. Classic case in point is when you do retire and your fund goes from a accumulation mode to a pension mode, you're not able to do what's called an in-specie transfer, which is actually pick up your investments and move them across into that new account as you're going into retirement phase. They require you to sell down all those assets, and what that does, that triggers capital gains tax in your super fund that you've accrued for the life of that super. You are selling their funds Now, most funds have a bid-ask spread, spread between the buy and the sell price, about 3%. So they're going to pick up 3% on the sale of that. They move the cash across into a pension phase, and then you put it into your new pension account, and then you buy everything back again, once again paying a 3% spread. So essentially you could pay quite a lot of tax and then 3% as you sort of navigate that process. And that's the warts and all view of industry super funds. The other problem you've got too is, like I said before, you do have an issue with liquidity. And what we're going to start to see out of all of this is that great saying about when the tide goes out, you know who's been swimming naked. And these sort of events unfortunately play out very quickly, and unless you're able to manage your portfolios in a very liquid and transparent manner, you don't really know what the full effects are until after the fact, because it takes a long while for a lot of these things to price out. And what you're going to, without going into too much detail, the industry funds have a pool of funds that they use for profit smoothing. So rather than giving clients members all their the profits from they always retain some, and then they'll use those profits to bring forward to sort of fill the gaps as the period go on. And that's how they're able to, from a member's point of view, appear like they're performing very well all the time. The problem they've got right now is they've got unlisted assets that are not liquid. They've got a massive amount of redemptions, possibly up to 50 billion, coming out. Profit provisioning is not there anymore. So we're not going to really know until everything comes out. The other problem with the industry super funds is, by law, they only have to tell you about 27% of their fees that they actually have in the background as well too. So they really have always been cagey, and they've relied on their good marketing campaigns and performance. But we're going to see this in terms of, do you move now? I can't really recommend it or not recommend it. All I can say is you need to speak to someone and, to use their phrase, compare the pair. Okay, with Abdul here, I'm not understanding the main residence exemption regarding that property. What is this about? Look, Abdul, I won't go into too much detail because we've got a lot of details on our website. So if you want to go to atlaswealth.com, I'll just put that up on the screen here right now. Go to our website, and as you'll see here, if you go into our blogs and you can search for keywords, you will see that we've produced, I think at last count, 14 articles about the main residence exemption. It's something, if you do have a former principal place of residence in Australia, you do need to be aware of. You don't have to act, but you need to be aware of what the repercussions are. Okay, question here from Charlotte. Do you think any such landlord tax relief would apply to expat landlords, or will we be exempted from that also? And big frowning face with the emojis. Yeah, good question, and a lot of clients are asking that question. To me, if they're going to tax you as taxable Australian property like they do with residents, then they should, and I say should, provide you and afford you with the same benefits. I would like to think so. If they're taxing you like taxable Australian property, then they should do that. In saying that, we're not sure, to be honest with you, until you see the legislation and until you see the fine print. I can't say either way, one way or the other. My gut tells me yes, they will provide for expats, but in saying that, watch this space. As soon as we, obviously have more information from Canberra, if you go to our website, atlaswealth.com, when you go onto the website for the first time, you'll see a little box at the top, which always annoys me for everything else, but I will tell you this time to keep it, to hit allow for us to hit notifications, because we are producing a lot of blog articles, with respect to expats and COVID-19. And as soon as we know any more information about this, we'll definitely be sending out to on our website. And so atlaswealth.com, and also too, I'll just change the screen here and also show this is how we mainly send out a lot of our information with respect to communications. LinkedIn, we're also on there too. I just realised that the guys forgot to put LinkedIn on there as well too. So using Facebook, Twitter, Instagram, not so much, but definitely LinkedIn. We'll certainly let people know, and my gut tells me that they're going to be coming out in the next couple of days, because this rental side is causing a lot of grief already, and if they don't jump on top of it very quickly, there could be a lot of problems coming out of that. Okay, question here from Rachel. Should we as landlords reach out to tenants even if we don't foresee a problem with them paying their rent? Look, but probably my response to that would be if you want to get access to the tax incentives, then yes. But, you don't need the access to the tax incentives unless you're going through that financial distress because you do have a tenant in default. So, I think, we're all adults. We know how to play this game, right? To me, if everything's copacetic and there's no problems at all, then, yeah, look, keep it as status quo. But if you do think, and to me, it's usually always good to reach out to your property managers to try and gauge what's going on and determine, okay, we've got an issue here or we don't. They're the ones sitting at the front line. They're the ones collecting the rent checks, and that's how you'll find out very quickly whether you're going through any experiences or not. Okay, let's get a glass of water here. Okay, so question here from Rachel. Should we as landlords, it's almost the same question as Charlotte. So, oh no, sorry, that's the question right before. Let's go to the next one here. What have you seen or heard being reasonable negotiations between landlords and tenants? How long's a piece of string, to be honest with you there, Tony? To me, if you want, expect and need and require to access to these tax incentives, then you've got to show something, whether it's 10%, 20%. I think taking everything at face value, trying to gauge the requirement, I certainly wouldn't be just cutting things in half just for the sake of cutting things in half, that's for sure. So certainly from a landlord's point of view, first port of call will be talking to your property manager just to see whether they see any problems, and then trying to gauge the level of the problems. If that household has suddenly lost all their income, then yeah, you're going to have to be quite aggressive with those cuts. Bearing in mind too, and something I'm not sure if I covered in that slide on property, was the 6-month moratorium for housing evictions. So this has got to create issues both with expats trying to sell their properties before the 30th of June, and also too just for those standard landlords as well. So you can't actually evict your tenant for 6 months, and that's got to create a lot of issues. So certainly, from what's reasonable, I think you need to take it on a case-by-case basis. I've heard anything from sort of 10 to 50% at the moment. I haven't heard of any 100%, but 10 to 50% I think would be a fair and reasonable range, considering that people are going to be able to pull out $10,000 from super. They are going to get access to the job seeker. There's a lot of other things coming through as well too. But yeah, definitely need to play that one by ear. Okay, another question from Tony. For periods when you are non-resident for tax purposes, does any share or ETF on the ASX count for no capital gains tax? The answer is yes, with a caveat. For those people who owned a share portfolio before they moved away and did not do deemed disposal, they are still continuing to accrue capital gains tax. Deemed disposal virtually means that when you were about to jump on the plane, you made an election in that tax year on that date that you're selling your share portfolio on paper, you're paying an applicable capital gains tax, and then from that date onwards you don't accrue capital gains tax. If you did not do deemed disposal and you bought BHP shares back in 2010, then you would still be accruing capital gains tax today. So coming back to your question, Tony, it's any share that's, as long as it's essentially classified as a share, a ETF, LIC, anything that's the safest way to describe it is if it's trading on the ASX, yes. There are what we call managed investment schemes that some do and some don't, but once again, I don't want to go down that rabbit hole. I just want to keep things nice and simple for people. Okay, on to Rachel's question here. If we do already have an account set up with our parents' address in Australia, should we change this now moving forward? 100%, Rachel. To me, the best thing you need to do is call your account provider. Sometimes it's okay to have a local address as long as the account provider has nominated you as a non-resident. And you can have two types of address on an investment account. You can have a postal address and a residential address. The proper way of doing things is obviously have a residential address being your overseas address, and if you do want mail to go locally in Australia, then put your parents' address on that. But you do need to call them to make sure that that's definitely the case. If not, and we have seen a lot of people who have run into problems, just sing out to us on our email address, which is info@atlaswealth.com, and more than happy to provide some guidance around that. Okay, David's just saying just lost sound. Hopefully you got us back there, David. Question from Catherine. A couple of mid-30s, super imbalanced option with Australian super. What would your recommendation be for super portfolio during this time? High growth, balanced, index diversified. Probably the biggest problem, Catherine, is the fact that we're not allowed to provide personal advice on these sort of calls. So we can only talk in general nature. Look, it depends on your fund. And unfortunately, there's no standardisation with any fund in Australia. So you could look at Australian Super, Host Plus, Rest, AMP, Colonial First State, and they can all be balanced and they can all be completely different. So you'll need to talk to someone, a specialist who can go through and analyse that, give you an idea, as part of what we do for our clients. When we do analyse our clients' super funds, we ask those funds about 40 questions. So, and half the time the folks on the call centre can only answer about 10, and then they have to transfer us to someone in a higher authority. So the devil is in the detail, and obviously I can't go into personal advice, but definitely you need to speak to someone about going into more detail. Question here from Ross Gordon here. How do you see oil playing out? Look, to me, oil, it couldn't have come at a worse time. You've got, the Saudis and the Russians who have been playing nicely up until now, controlling supply and everything. I think the Saudis probably just got fed up with the Russians' antics and decided to go into the power play. If we weren't going through an economic slump because of COVID-19, I would say it would not be a long process, because the Saudis have a lost cost of production than any country in the world. I think from last memory I looked at it, it's about $7 a barrel. So they can certainly wear this out, whereas I don't think the Russians could. In saying that, obviously demand will be down, and there are companies actually benefiting from a low oil price. Obviously the airlines are not, because they're not flying, but as a by-the-by, companies like Amcor, the paper and packaging business, the resin prices have fallen a lot, so they can actually produce their cardboard boxes for a lot cheaper. And as you can imagine right now, with consumer staples going through the roof due to Coles, Woolies, Costco and all the other providers, they're doing a roaring business. So in terms of where I see oil going, I'd probably have more conviction with respect to the equity markets than the oil right now, because whether we have a come to Jesus moment between OPEC or not, it really depends. I think the Saudis have got the controls, their hands on the reins there, and you might see a very humble Russian government come back to them and say, rightio, we get your point. You made your point. Let's just get back onto the straight and narrow and start to rationalise this. But to me, there's still too many unknowns with respect to oil, because of obviously the politics and demand from the economy as well too. Question here from Gil. Paul from Paris, CAC 40 and DAX are both down by 35%, while ASX only down by 12%. How would you explain that? Look, I would actually question that. The ASX will be down a lot more than that. The only thing I would say is the markets are moving so quickly. So as an example, when that policy yesterday was announced by the Australian government, the ASX was up 7% in one day. Now, if you compared the two markets with that being up, France hasn't factored in the fact, or nor would it, or Germans or the French markets wouldn't factor that in. But now today, the ASX was down 2%. So I would actually say, off the top of my head, I'd say the ASX is actually down about 25%. But the only thing I could say is maybe looking at it on a currency adjusted basis. So, but I would dare say, certainly, the ASX has fallen a lot more than that. Question from Alexander. You mentioned not opening investment accounts under friends' families' names. Can you recommend investment platforms that allow expats to invest in as non-residents? This is going to seem like a really cheesy line, but we've negotiated with two platforms that allow our clients to do it, and that wasn't easy. You obviously have to be under our advice to do it. So it's becoming, from a compliance point of view, with these platforms, more of an issue. We've got the Common Reporting Standard, FATCA, everything it's facing with. And those who are low-cost providers, like the discount platforms, have just shut up shop and said no more foreigners. The providers that we use, Hub24 and NetWealth, they're virtually allowing us and allowing our clients on there because they understand the amount of compliance that we apply when our clients come on board, and they're not nobodies who are running around with sort of drug money or money laundering. So certainly reach out to us on our email address at info@atlaswealth.com. Different platforms have different appetites for people in different regions. So for example, Hub24 won't allow our clients who are based in the US to use it, whereas NetWealth will, and NetWealth won't allow our clients in Europe to use it because of GDPR. For those in Europe will know exactly what that is. So we have to use Hub. So it's not an easy process, and we've been able to get through it just by providing a lot of compliance and providing those platforms a lot of peace of mind. Okay, question here from Paul. It has been a sharp impact. Do you see that correspondingly it could be a sharp recovery as restrictions are lifted? Yeah, look, definitely, Paul. Right now the debate to me is between a V-shaped recovery or a U-shaped recovery. So it's going to really be dictated based on how long this draws out for. If government's manage is smart for the next, sort of 30 days, then we could see a very rapid peak, and then we're more looking at a V-shaped recovery. If this goes on longer, people aren't self-quarantining, then that's when more damage is done. Certainly, there is always a danger with averages, and by that I mean, on average, we might see a V-shaped recovery in the market, but in certain sectors, possibly not. And our clients would have heard me say this 1,000 times with respect to the danger of averages. If you put your head in the freezer and your feet in the microwave, on average you're a good temperature, but not very comfortable. So there are going to be some sectors which recover slower than others. There are a lot of sectors where the baby has been thrown out with the bathwater, and those will be the first to recover and the quickest to recover. And we're looking at a lot of those sectors right now, and they're just sort of battening down the hatch and controlling costs, and we know they'll bounce out of that very quickly. Okay, so running through the next one here. Okay, from Kathy, working overseas, can we borrow money in Australia to buy property? Yes, you can, Kathy. It's not easy. And if you front up to a CBA or Westpac branch, you'll probably get cross-eyed and they'll probably ask you to go away. It's moments like that that we, working with a specialist that, knows how to navigate that space. We have a number of mortgage brokers who a lot are actually former expats themselves, so they know how to navigate that space. It will depend on the jurisdiction you're in, whether you're earning a gold or a silver tier currency, and obviously the tax rates applicable in those countries, and most importantly, the appetite of the bank. So before all this occurred, what we saw was, banks' demand for expat loans sort of waxed and waned, and a good mortgage broker talks to those banks every week and knows who's taking expats and who's not. Now that we've got banks almost going risk off, there is a real risk that new funding for banks may dry up very quickly. So to me, you need to speak to someone. We're more than happy to put you some recommendations through. So feel free to email us at info@atlaswealth.com, and we can certainly give you some people to talk to. Okay, question from Nigel. Maybe a silly question, but where are the governments getting the money from now for the relief, and then how is that money going to be recovered once the pandemic is over? No, it's not a silly question at all, and it's got to come from somewhere. So essentially the governments make their money in a normal practical market. The governments make their money by issuing bonds, to investors in the bond market, the fixed interest market. So they might go out and say, guys, we need to raise $5 billion, and this is the rate we're willing to pay, and it's going to be, for this term or period. And that's a natural part of the way governments manage their cash flow, because if you think about it, really the governments only, they make their revenue as the year goes by, and they collect GST and personal income tax and company tax, and that starts to peak towards the middle to the later part of the year. But in the early part of the year, they don't actually have a lot of receivables to actually pay for their ongoing bills. So what you'll see is a spike in bond issuance early in the part of the year, and that'll phase down through the year as revenue comes through and picks up the slack. When you do see these sort of events occurring, you will start to see more issuance of bonds by the governments, and also too, you will see the governments go cap in hand to World Bank and a lot of other places to try and raise capital. probably the best thing in this sort of environment, because yields are so low, they are able to borrow money very, very cheaply. But also to flip it on the side, remember before I talked about S&P, the rating agency, if we do lose our AAA credit rating, then the cost that the federal government has to pay in offering a yield will be a lot more too. So, but no, very good question there, Nigel. Got a question here from Nathan Lewis. Should I be buying shares, ETFs, or both? Once again, answer is depends. If you only have a small amount and in order to gain proper diversification, then yeah, certainly it's a lot easier just to buy an ASX 200 ETF. If you have a larger amount, you might actually incorporate both. And we manage both our client super funds and investment accounts in-house, and we actually use both. And the reason we do that is because ETFs are fantastic in getting very quick exposure to a market, but there are some inherent risks. The biggest one, and it's more particular to Australia, is when you buy a ASX 200 or All Ordinaries index, what a lot of people don't realise is that 38.5% of that index are financial services companies, banks. So for 40% of your portfolio, you're hitching your cart to the banking sector and hoping like hell that does well, because even if the other 60 doesn't, or does, that 40% could be a handbrake. And the biggest problem we see in the horizon is right now the banks are acting as the shock absorber for the economy. So they're obviously providing concessions to both retail and commercial clients with respect to payment windows and 6 months flexibility and so on and so forth. But combine that with that chart I showed before regarding defaults, the banks could be under increasing pressure in the next 6, 9, 12 and 24 months. The biggest problem we see with banks is the banks make their money with what's called the net interest margin, which is virtually the difference between how much they borrow their money for in the open market and how much they lend it to you for a mortgage. Right now that's at 1%. So they're only making 1% on all of that money. The way they get through it is scale. They've just been trying to provide all these loans out there, hence the reason for the property boom. And that has been lending. But now that's the risk we see with buying just a pure ASX index. I mean, as an example, in the US, there's no one index or sector that is larger than 15% of the S&P 500. So they don't have that problem over there. So what we'll often do is we'll adjust using direct equity as a portfolio in Australia and buy direct equities and try and downweight the banks. But then with our overseas holdings, we might buy an S&P 500 to get access, and then overlay some individual holdings around that too. Okay, question here from Huang. Look, I think I mentioned it before, about what platforms we use for expat investors. It is becoming very difficult. It's if you're looking at an Australian account, there's pretty much no one from a discount broking point of view that will do it. There are people in there who were in there before the gates came down. They're okay. But if you approach a ComSec or a NAB Online, I'm afraid they're probably going to turn you away. The two platforms we use, NetWealth and Hub24, only allow our clients on there because we are advising our clients as we go, and we're providing our compliance framework on top of theirs that gives them a bit of peace of mind. Question from Jane, do you know of any online trading accounts? Yeah, Jane, probably same question as Wong there and the other ones. Yeah, in terms of an online account, no. I think, unless things have changed dramatically, and given what we're going through right now, I think it's probably going to get worse as people sort of batten down the hatch from a compliance point of view. There are no online brokerages that allow you in Australia to set up an account. How low do you expect the ASX will go? To be honest with you, I think there's a question there from Philip. Look, to me, it depends on how this plays out. If we see US deaths spike, if we do breach that 200,000 mark that everyone's talking about as a limit on the US deaths, then we could see go a lot further. In saying that, not all stocks are going down right now. Coles, Woolies, Wesfarmers obviously have been going up. Companies like CSL have been going up. InvoCare, which is the largest provider of funeral homes in Australia, is going up. So in terms of an index, definitely see there's more risk on the downside. But in terms of if you strip back and look at individual companies, we are starting to see a lot of support come in for certain companies that aren't doing badly at all. One of the the holdings in our portfolio at the moment is Ansell, which everyone sort of snickers when we talk about it because they're famous for condoms, but one of their biggest businesses is actually hospital supplies. So they've been doing very well. I said Amcor's doing well. It really is, comparing apples and oranges when it comes to comparing the index versus individual companies. As a general, do I think the index has further to go? Yes, I do. But in terms of how much further, it will be predicated on the amount of information that comes out in the next week or two. Okay, next one from Amy Cornell. Thanks for the info on risk-free industry super funds. What actions should members of these funds be weighing up in light of this? I think it's a brilliant opportunity to go and have a good look at what you're invested in, what risk profile, what the returns and so forth, just to make sure you're invested appropriately. The last thing you want to be doing is investing as a high growth investor if you're moderate defensive. So, at the same time, maybe the risk is, the change has already happened, it's too late. It will depend on what plays out in the next couple of weeks and months, but you do need to look at your numbers. If you don't know what you're looking at, definitely engage someone because they don't make it as easy as it should be. Question here from Sandra. If you return to your property in Australia and live there for 12 to 24 months again, will you be able to sell it CGT free again? Or will CGT be prorated based on the amount of time it was rented out versus lived in? Sandra, good question because it causes a lot of questions and concerns with respect to property. So if you have been overseas for longer than 6 years, let's say for example for 8 years, and then you move back into the property, then yes, you will have to pay, you will receive what's called a partial main residence exemption. So for the 6 of the 8 you will, but for that 2 years you still have that non-resident capital gains liability. Question here from Sarah Crocker. My business is in Australia and headed towards bankruptcy. I'm really sorry there, Sarah. That's never good to hear. I live in France with no income and that is French-based. What aid is available to me? Look, at the moment, as I said before, in terms of access to the job seeker, super and all those sort of things, it really doesn't, it's not apparent what the fine details are. What I'll ask you to do, could you just send me an email at Brett, brett.evans, E-V-A-N-S, @atlaswealth.com. Let's have a chat and see if I can help you out there. No charge, but, I hate to hear those sort of stories and would love to help if I can. We've got contacts both obviously back in Australia and in France that we can try and see if we can, get you some help there as well. Question from Lisa Morgan. Is there a way for unemployed expats to access unemployment benefits from Centrelink, and must we be back in Australia to apply for these? Lisa, generally speaking, yes. In order to go to Centrelink, you do need to go through the process of being classified as Australian tax resident, and the obvious reason for that is they're worried of people being overseas sort of rorting the system. So generally speaking, yes. We are going to be combing through all legislation, cutting out in the coming days and weeks with a fine-tooth comb. So, whatever we see, good, bad or ugly, we will make everyone aware of what your options are. At the moment, myself and the team are sort of working, sort of 15-hour days at the moment. So we're hoping to get a bit of breathing space in the coming weeks, in which case we'll be actually making phone calls to these agencies and trying to find out. We're in obviously amazing, crazy times at the moment. Not amazing, but I don't like to use the word unprecedented. I think every person under the sun's used that so far, but certainly from our point of view, we want to try and get the best and most correct information to you guys. So definitely follow us on the social media, jump on our website, hit yes to notifications, because as soon as we know that, you'll definitely know. Okay, another question here from Sharon. Do you agree that this will see a fundamental shift in how businesses work and employ people, like we saw after the 1990s Asian financial crisis, when companies simply didn't get more lean and efficient and didn't re-employ in the same way? 100,000% Sharon. I think we even saw that after the GFC. Companies were expecting people to do 2 jobs instead of 1. It's not until a number of years after do we see that relaxation and balance sheets start to expand and more job hiring process. I think we can go one step further, and I think we're going to see a demographic shift in countries and towns. Unfortunately, there's a high attrition rate with elderly people with COVID-19, and you're going to see the actual average age in these towns, drop down remarkably, which is sad. So from our point of view, do we see, companies being tight? Yeah, definitely. I think they're going to always go too far, and then they'll slowly start to wind their way back. I experienced that myself when I was working on the money market floor for Suncorp. We went through the Suncorp and Metway merger, so those in Queensland will know who I'm talking about. And they virtually, pretty much got rid of 2/3 of all staff, and then merged two companies together because they thought there was, all these synergies to be maintained. That wasn't the case. Surprise, surprise. And we're doing two jobs. So I think exactly the same thing is going to come out of here. Question here from Georgina. Do you think that the proposed tax cuts for landlords who agree to waive rent are likely to provide any assistance in practice to overseas landlords who are also going through the same pandemic? Let me just try and just read that. Likely to provide any assistance in practice to overseas landlords. Look, like I said before with that previous question, I would like to think that as the Australian government is taking their pound of flesh out of you from a tax point of view, that they should also offer you the same incentives. We don't know. We'll know more in the coming days when they announce this package. And as soon as we know, we'll be, jumping straight onto it and getting the information. I would like to think so, given what everyone's going through. But, we'll have to wait to see those details. Just a question here from Khalid. What happens to CGT exemption if you sell your property after 30 June when you go back to Australia and you're a resident? Look, Khalid, virtually it relates to how long you're away from overseas. If it's within a 6-year period from living in a property, moving overseas and coming back again, anyone who goes through that example will obviously be able to make themselves available to the main residence exemption. If your period is longer than 6 years, then there might be a partial main residence exemption. But certainly everyone's experiences are different there, so you might need to reach out to someone just to really quantify what your exact circumstances are. Question from Robert Smith. We're looking to return to Australia this year. With all that's going on in CGT situation, is it still okay to buy our main residence before we return, or wait until we are full tax residents again, currently USA green card holders with non-revenue gaining share in a home my in-laws live in? So I guess, Robert, you're talking about buying out your in-laws and buying and taking the greater share. Look, that's a complicated one because not only do you have issues with respect to the ATO, but also to the US, obviously by virtue of your green card holder. So my colleague who's not on, who usually co-presents with you, James Ridley, he's obviously in Australia and in his pajamas fast asleep. So that's a great question for him, because he handles our US-based clients. So definitely recommend you reach out to James. His email address is james, James, .ridley, RIDLEY, @atlaswealth.com. And James will certainly be able to help you there, because you do have quite a number of moving parts there as well. Question for Abdul. Please ignore my question. I figured it out. Okay, no problems at all, Abdul. Kathy, I have property in Italy. Should I transfer money to Italy as well as Australia? Look, it depends on, Kathy, a lot of things. Depends on the currency you're earning, yourself. If you're earning US dollars, then, that may be different to someone who's earning another currency as well. So, to me, you really need to take that, what we call the 40,000 foot view, and look at your asset allocation and the tax rules that bolt underneath those assets to determine what you should and shouldn't do with respect to what money you should be transferring where and what you should be doing. But certainly we talk about, mentioned before, at a general aspect, if you do have an intention to return or retire to Australia, then that should be the mothership when it comes to managing your assets. Question from Ben Butler here. Any thoughts on where the US dollar may head with stimulus plans, impacts on inflation? Look, on the US dollar front, it is the bolt hole for nervous investors, so you are going to see a seesawing effect. If the US was the only country that cut interest rates to where they are and was having to roll out the stimulus package, then yeah, the US dollar will be down the toilet, and all other currencies, including the Australian dollar, would be very strong against it. Given the fact that we're all in the same boat and there are a lot of question marks, I would hazard a guess to say that probably the US dollar is probably the lighthouse in the storm at the moment, and I can't see that really changing for the next probably 3 to 6, 9 months at the moment. A question here from, so Ben, okay, question from Yan. How to set up a portfolio investment account with Atlas? I'm moving back to Oz. Yan, just drop us an email at info@atlaswealth.com, and more than happy to talk through that process. Question from Emma, if we're not looking at investing but looking to, sorry, we're not currently investing but looking to, what strategies, what would you suggest? Stocks, property, holding off? Look, Emma, all depends on price. You know, it's amazing how, you know, sometimes you can look at a market and get the benefit of hindsight to see what's cheap and what's expensive, and what, you know, the market from an equity point of view, you can rely on for real-time feedback as to if that's a good company and a good sector to be in. And the way you do that is you just compare that market and that sector to how everything else is going. If it's only been sold down half of what everything else has been sold down, then you know there's some resilience, and that should be, you know, part of your consideration. If it's been sold down more, you know, online on the Facebook groups, you know, it almost angers me when I see people saying, oh, they're just going to load into Qantas because the government's going to bail them out and make a fortune. Yeah, look, they will definitely get a bailout, as will Virgin, but the market looks at forward earnings estimates, and if that doesn't look good, and you might remember back in September 11, you know, the travel sector was very benign for quite a while. Even though September 11 was one day, it took a while for that travel and transport sector to really start to pick up again. So to me, you know, go in slowly, do your research. The internet's a great thing. There's a lot of information you can find out there. Only read reputable providers of information. There's a lot of nonsense out there as well too. So I guess in a very sort of roundabout way, always look behind the person who's putting the information out there. So, for example, I would not be reading a property magazine to determine whether it's the right time or wrong time to buy property. And the reason for that is they're in the business of selling property or selling subscriptions to people to buy property. So they're not going to give you that impartial information, and nor is a news publication that relies on property advertising on the weekend in their papers to talk about it. So you need to look through and find some impartial commentators, and there's quite a few out there. Certainly the data providers, the ones that we find are the best, because data is binary ones and zeros. There's no emotion, there's no agenda. They're not getting a commission by telling you one thing or the other. They're just going to give you very factual information. So if you are going alone there, Emma, certainly you need just to, you know, tread carefully and make sure you understand the bona fides behind the people providing information. Being based in the Gulf, you know, we know that only too well. You know, most information provided here is very opaque from a lot of the financial institutions, and they don't tell you everything. So, yeah, you want to make sure that you understand all the facts and all the costs associated. Question from Kathy, is it a good time to buy Australian shares as an expat? Look, I think we're almost there. You know, to me, as long as they can sort of cap everything going on at the moment, cap that that contagion effect, then yeah, the market will bounce before we actually see everything flatlining, if that makes sense, because the market's always forward-looking in advance. So certainly we are getting very close. For some of our clients that are saying, you know what, I'm not going to be greedy, I'm just going in now, which is fine. You know, they're paying, you know, sort of between 15 and 30% lower values than stuff that was for sale back in February. So to us, the downside risk is probably less than the upside, is less than the upside potentials, which is what you want. You're only paying for assets that have only been sold off for 5 or 10%, and there's 30% downside risk. With respect to property, that's definitely the case right now. You know, if the numbers do play out, if the numbers are correct in terms of the unemployment numbers, then every person with a solid reputation says that property is going down 20% if we do get into double-digit unemployment. So, and there will be some markets who go down more and some who go down less. You know, obviously markets that haven't moved up much in the property game, Adelaide, for example, you wouldn't expect them to be sold off as much as, say, the Sydney and the Melbourne markets as well too. How low do you expect the AED to go? From Philip, look, it's going to be coming down to A, credit rating, which we discussed, B, China's economy. Those are the two things. And also C, you need to understand sometimes the Australian dollar can appreciate, not because it's getting stronger, but the other currency is getting weaker. So it really is just, it's like tapping your head, rubbing your stomach, hopping one leg and chewing gum at the same time. There's a lot of moving parts that will dictate what the Australian dollar does, and it would be impossible to model every scenario. But from our point of view, there is certainly, you know, we saw a floor form around the sort of 56, 57. That may be the new norm. That may be, you know, the hard floor, which, you know, investors are happy to buy Australian dollars back, but we'll know a lot more once this China data comes out, and also to what other countries are doing it as well. Question from Michael. I was recently told by CommSec that since moving to the UAE, I can no longer use their platform for buying and selling shares. Have you heard of this before, or know why not might be the case? Yep, Michael, that's well, start again. It's what I was saying before about some of these platforms taking an internal compliance decision in terms of not allowing expats. So this is not, it's illegal to do it. It's just CommSec making this view, and all the other platforms are doing it as well. We have to jump through a lot of hoops for our clients in both the UAE and the Gulf region to be able to invest for them. So, you know, if you have any problems there, you know, sing out at info@atlaswealth.com, and more than happy to help you. Question from Wendy, purchasing shares whilst non-resident. If I had an online Oz broker to purchase a portfolio before becoming non-resident, now residing in Luxembourg for 3 years, with mail redirected to my family in Oz, should you move your portfolio to another online broker who takes non-residents? Wendy, look, I would say you won't want to jump out of the frying pan to the fire. If your platform you're on right now has you properly classified as a non-resident, then I certainly would not move. If they don't, then you've got an issue, because there may not be another discount broker that would accept you. And second of all, you need to address the issue of deemed disposal, which I discussed before. That's a big one as well too. Whether you did deem disposal before you left, yeah, there's a couple of moving parts there. So if we can help out, you know, info@atlaswealth.com. Question from Ben Wong. Are expats able to open brokerage accounts like CommSec in individual name? Look, I think we've covered that before. You know, the answer is no, and certainly as pointed out by Michael before. Question from Kelly. Since June last year, we were considering changing my Host Plus Super into a purchase of a pink diamond via a self-managed super fund. Do you think now is a good time to make this change? Look, Kelly, at the end of the day, there's three big things here. First one is you got good taste. Second one is expats shouldn't have self-managed super funds. Very few, if any, meet the central management and control tests. By that I mean you being overseas, you know, there are rubber stamping issues that the ATO does not like with self-managed super funds, and that is normally around about appointing a friend or a relative as a trustee or director to say that control is being maintained in Australia. The first thing the ATO is going to ask you is how much of that friend or relative have their own money in your super fund, and you know, they'll be concerned regarding the active members test there too. So long story short, I'm not providing personal advice here, Kelly, but you need to tread very, very carefully with that one. Question from Jennifer, remind us on rules for deemed disposal. I relocated to US this year. Can I pick the lowest point until 30 June? Unfortunately not. It's the date of departure. So when you are deemed to be a non-resident for tax purposes, that is the date that you are meant to deem to have disposed of your shares. It, you know, obviously you do that when you do your annual tax return. So you don't do it, actually make that election on the day, but you will make that election when you do the tax return for that particular year. So yeah, you certainly still have a window open there. Okay, question from Khaled. Do you expect the Aussie dollar to drop less than 50 cents? I wouldn't, but I wouldn't be surprised. I think the chance of going below 50 cents is probably, you know, 10%. I would never rule it out, because certainly we're dealing with a beast at the moment that is unpredictable and is affecting the economies and countries in ways that we never thought would be affected. So I'll never rule it out. I think, getting below 50 is a slight chance, but I don't think it's a big chance. Question from Brock: would you dollar cost average be the best strategy now, starting per month, or would it be better to wait a couple of months to start the following more info coming out of countries? Yeah, look, a great question for Brock. And just to explain to people, what dollar cost averaging is when every month you go in and you might either change a currency or buy a share every month with discipline. And what you're doing is you're buying and changing at different times, getting different prices. But what actually happens is it averages out. So let's say, for example, you started dollar cost averaging today. So I went and bought BHP shares today. Next month, at the exact same time frame, I bought more BHP shares, more BHP, and so off you go. You may not have picked the bottom when you first started to invest, but at some point you'll get a very nice rounding effect. And as things pick up, you've virtually locked in your prices at the lower levels, and then you continue and your average price looks good. It certainly is a very conservative approach for someone who's really trying to find it difficult to find that entry point, and it's never a bad strategy when you're looking at dollar cost averaging, both in currency and also in investing in equities, because as I said before, you don't know you've hit the bottom until you've gone past it. So we don't know where it's going to be. To me, I would say to anyone who's looking at dollar cost averaging going into the current pricing point, go with your eyes open, be big picture in your perspective. If you're taking a 5-year view, whether you buy in March, April or May, may have a little effect if you're looking at 5 years down the track. So I think you need to look at that, but certainly just go in, and just tread carefully, but dollar cost averaging is a very good strategy in these markets. Okay, question from Daniel here. Does the UAE Central Bank have the reserves to maintain its USD peg? Look, they've been quite vocal of recent with respect to their capital reserves, and they keep saying they've got tons. I believe them, because the amount of regulatory oversight from a world point of view and the amount of pressure that all the reserves are under for transparent reporting are pretty strenuous now. So if they say they've got a lot, then I would believe them at face value, but the situation can change very quickly. So I would say, yes, they do have the reserves to be able to maintain that peg, but give me 2 months' time with more information, and then I'll be more, qualitative and with more conviction on that statement. Question from Benham here: would you say it's a good time to buy a property, or would you recommend holding off for a couple of months? Look, right now, I don't think we've seen the full picture of property at the moment. Unlike equities, where you can put on a computer screen and see it real time, with property we don't. We don't know what's happening in the background with hundreds and thousands of homes around Australia, and whether we're seeing we know that obviously the clearance rates shattered down to almost levels we haven't seen since for the last 30 years. So, but to me, the biggest problem is you got to see a domino effect. So the first effect is going to be buyers dry up because no confidence, and B, they can't get the loans. The second one will be people losing their homes. Yes, they have a 6-month moratorium on them, so they can stay there and not pay rent or not pay their mortgage, but can that get them out of that decline? The problem they're going to have is, as we saw on those earlier charts, people are loaded up to the gills when it comes to debt. So right now it's about 190% of disposable income. So they really couldn't afford those loans before they went. We went through this event, and to me, you got to see people who. To me, there's two categories. There's those who are just owner-occupiers. They're going to have problems. The big ones are going to be the Mr. and Mrs. Smiths who sort of jumped on the property bandwagon. Realistically, they should have only ever owned 1 or 2 properties, but they got caught up in the hype. They kept re-gearing and refinancing and drawing capital out and buying the next one. Yes, they probably owned 5 properties. They've got virtually no equity in any of these properties, and certainly no buffer to whether A, their own tenants not paying their rent, and B, their debt servicing levels because they themselves have lost their property. So to me, we're not going to get a true and clear picture on the property market for probably 3 to 6 months. as all this pans out. But the data is going to show us with clear conviction as to what's happening, because through that ABS chart pack that I mentioned that gets released every month, all the data that is registered with the local states in terms of property transactions will be recorded, and you'll see on the charts very quickly what's happening there. Combine that with B, obviously what's happening with delinquencies in terms of bad debts through the banks, that's recorded there as well too. But we're not going to see a true picture for at least 3 months or 6 months. So certainly I'll be sitting on my hands right now. Question from Jack: how much do you see Sydney properties dropping by? When do you think the drop will occur? I think the second part of that question I just covered in terms of how far do I see how far do I see the Sydney market falling itself. Probably Sydney, I'd say it's going to be the worst out of any of the markets, and the reason I say that is they're the ones who are most leveraged. They're the ones who have experienced the biggest highs, and when it comes to panic selling by investors who probably should not have geared up so much, that's going to be the first market to go, and always is. Sydney, Melbourne's always the lead, and then the other markets follow like a ripple in the pond as you throw a rock. So, the other markets, you don't see as big effect as you do see from those major markets if they have gone through, what they've gone through at the moment. Question here from Kathy: how do we register to become a client? Kathy, just there's 2 ways you can do it. First way is you can go to our website, atlaswealth.com. There's a button there about contact us. Fill in the form, send your details through, and either someone from the Dubai office or the Gold Coast office in Australia will come back to you, obviously depending on which location you're located in. Karen Trickley asked the question: can you give us your top 3 superannuation fund suppliers? Once again, Karen, it really depends on the person. So if you're a 20-year-old with a low balance, then there's probably any of the industry funds that are recommended. Usually by someone like Finder, they'll tell you best one to go. Because you've got such a small balance, it's all about the cost. It really doesn't matter about returns, because your ongoing contributions are going to be far greater than the actual growth of the fund. When it comes to those in their 30s, it's going to depend on those in their 60s. Obviously, I'm going to always say that how we manage our clients' super funds is the best way. And we find that it's the best way because they're designed for expats. So our super funds can help a client in Dubai like it can help a client in the United States, who have 2 completely different scenarios. And that's where I was talking before about our concern regarding industry funds with their liquidity issues. We don't have those issues because we manage our clients in a solo capacity. So every client has their own account, has their own holdings. And what we tell a client to do in the United States is different to the UK, which is different to Denmark, different to Dubai, and so on and so forth. So really, just to sort of, without providing you specific advice, Karen, it really depends on your circumstances and what you require out of it. Okay, question from Ashley. Thanks for the presentation. Thanks, Ashley. Here's another question from David. Are you hearing anything concrete about certain countries planning to hold China accountable for not releasing COVID-19 information in a timely fashion? And if any China trade repercussions do happen, with China being Australia's largest trading partner, how do you see this affecting the Australian economy? Great question. I mean, I think the first one was the FIRB rules coming in yesterday. That is virtually a boom gate coming down on China, because China was pretty much one of the largest investors in Australia. So that's Australia's way to saying, you guys aren't going to come in and take advantage of us while all our asset values are down. Second of all, we saw obviously the announcement coming out of the China health authorities that's saying, okay, we're going to do this right. Look, there's a lot of stuff doing the rounds on social media about the WHO being controlled by China and all that sort of stuff. Without being privy to anything, it is subjective. It's a guess, and I would say, to be honest with you, maybe, but you can't say with any conviction. In terms of trade sanctions, look, I think we're on the end of the whipping from China. We always are, based on the numbers and our reliance on them. We will try to send them messages by way of trade sanctions, but not trade sanctions, but trade negotiations. But really, when it comes to holding China to task in terms of their handling of this situation, that'll be more done by America and possibly Europe. But you'd like to think that this whole matter could be handled very differently, and I think we all agree it should have been. But in terms of Australia's capacity to, sort of hold the Bunsen burner to the feet of China, I don't think we've got a hope in hell of doing it personally. Short of reinventing our economy and becoming more self-sufficient, I don't see it happening, unfortunately. Question from Donna: if we sell a property over the next few months, but we'll be holding off buying for 3+ months, what do you suggest doing with the cash from the sale given the volatility of the markets? Look, Donna, you certainly wouldn't put in equity markets. Equity markets, you need to have at least a 2 to 3 year view, especially given what we're going through right now. It's going to be put the money in the bank, accept the miserly rate of credit interest, and yeah, that's about it, unfortunately. Question from Paul Anderson here: what about owning a holiday rental? Seems to neglect the ability to gain from rental breaks as tenants temporary. No, look, totally agree, Paul. And that's always the risk on the, I guess the benefit of taking holiday rentals is you do get a higher return, but you don't get that long-term lower sort of stable client. So once again, the devil will be in the detail with respect to who's going to be able to qualify or not with the upcoming allowances announced by the federal government. But I dare say, and hazarding a guess to say, that I don't think holiday letters will get as much of a benefit, but once again, the devil will be in the detail. Question here from Kim: do you know whether you can evict tenants if the owner wants to move back into the house? Look, Kim, the government's been very, very firm about this. There's a moratorium on rental evictions for 6 months. So, and we'll know more in more detail what that means, but the government has been very, very vocal that no tenants be kicked out. Unfortunately, there are going to be tenants who take advantage of this, which we get, but as we know more in the coming days, we'll find out exactly how that mechanism is going to work. Question for Donna: when transferring funds back to Australia, is it still recommended to transfer in amounts less than 10,000? Donna, great question. I'm glad you asked this because it really is being my bonnet about this 10,000. I just want to go on the record and tell everyone out there right now that there is no $10,000 limit for transferring cash back to Australia at all. The $10,000 limit only applies to carrying cash physically back into Australia and depositing cash into a bank. There's a government body called AUSTRAC, the Australian government body that tracks all money coming into and out of Australia, and they track everything from $1 all the way up to $100 million. If you transfer $9,999.99 and expect to be flying under the radar, you're more likely to be red flagged and investigated than if you're transferring $500,000. Your actions are quite clear that you're trying to avoid something because no one transfers such an obtuse amount of money. And what we always talk to clients about is when you're transferring money, you need to transfer it expecting to be asked about that money. So, they have algorithms and they will look for patterns. They will look for random numbers like a $9,999.99 to question you on why you're doing it. So when you are transferring money back to Australia, do not pick 9,900. Transfer 11,000 or 8,000 or whatever amount that be. You can transfer any amount of money as long as you have a clearly documented reason behind why that money is being transferred, then you're fine. You could transfer $50,000 tomorrow and you will not get asked as long as there's a plausible reason why you're transferring that money. And also too, when it comes to the narrative on that transfer, do not put income, salary, that sort of stuff. You need to put a plausible reason. If you are paying off a loan, put loan repayment. If you are investing, put investing, but just do not put anything that's too obtuse, because don't forget, they are watching a lot of money very quickly, and quite often what will happen is a computer will pick something up and make a judgment and then raise that with someone to investigate it personally. So yeah, great question. I'm glad you asked that one, Donna, because yeah, that really annoys me that rumor is still out there. Do you have any brokers you recommend expats use to buy Australian shares ETFs? Most local brokers don't allow non-residents. Question from Lauren. Yeah, look, Lauren, like I said before, that shop is shutting up, and the only way you can pretty much get access to investing in a portfolio in Australia now is using a specialist like Atlas Wealth. Question here from Nicholas Lewis. I wonder if you're related to Nathan Lewis. Yeah, same question again from Nicholas regarding Australian share portfolios. Yeah, Nicholas, you need to use someone like Atlas to do that, because it's not just from a regulatory point of view, but an internal compliance point of view. You know, these guys, they don't want to have the headache of handling non-residents. For people like ourselves, we do on a daily basis, and our systems are built for it. Whereas with someone like a CommSec or a NabTrade, yeah, they just don't have the time or the inclination to deal with it. Question here from David Skelton. I have an Australian share portfolio as a foreign resident for tax purposes out of the UK, as well as Australian interest earning bank accounts. I have failed to notify them I'm a foreign resident. Don't worry, David, I won't mention your surname, I might have before. How do I meet my tax obligations up until now, as my dividends and interest payments have not had withholding tax applied? Okay, David, the first thing you need to do is get on the front foot and contact your accountant, and which is okay. You know, there's nothing wrong with that. You can just do an updated tax return. That when you do your return, you just notify them, hey, by the way, there was these dividends and interest that was accrued. Certainly from that point of view, that's the first thing you need to do. The second thing is, obviously, you got to have an issue with respect to deemed disposal. You will still be accruing capital gains tax at the non-resident marginal tax rate from the date that you left. So you need to work out what you're going to do with that. Are you going to bite the bullet and sell them on paper and pay the capital gains tax, and from that period onward, you don't accrue capital gains tax, but also you've got the HMRC side on the other side as well to deal with as well. So you probably need to have a chat to someone and just determine, you know, work out the numbers, you know, what the best course of action there is. Okay, question here from Gil, looking to see how I can become a client. Gil, as I said before, you know, to everyone else, jump onto our website, atlaswealth.com, hit the contact us button and fill in your details, and either the Dubai office or the Australian office will be able to help you there. Question from Will. Obviously it's very early, but what is your estimated timeline for when we hit the bottom of the market? It's going to come down to the data. If we get on top of this early, not far. If this prolongs out, then that could prolong out the performance of the market. So, if we do see curves flattening, if we do see numbers, new numbers starting to drop, if we see the countries getting on top of everything, the market will rebound very quickly based on the amount of stimulus, the amount of money being thrown around. If we do see further spikes up, like right now we're seeing Hong Kong had it under control, but now we're seeing a second wave coming through. If that happens in China as well, obviously investor risk is going to be quite high, and they're probably going to sit back from the market. Okay, question from Matt here. You talked about working and living in another country and borrowing in Australia to buy a house in Oz. Would it be smart to borrow money in Oz in preparation to buy on a recovering market? So, Matt, I'm assuming you're talking about doing a redraw out of an Australian property and then taking the money and putting it into the share market. It will depend on your personal risk appetite. So for some clients, they've survived these bumps and they've survived these market events through a lot of volatility in the last 20 years by being unleveraged. When you're unleveraged, you're not as nervous about the market because obviously your returns aren't magnified in either direction. If you do have a high risk appetite and you're happy to play a very long game when it comes to that, then look, redrawing on your property may be appropriate for you. It will depend on what you do with that cash as well too, because don't forget, you do have increased serviceability of those loans. There's also going to be a tax consideration too with respect to claiming deductions on that portfolio as well, because as a non-resident, you can't negative gear and claim that back, but there will be a quarantining of the interest costs. So Matt, we know each other, so mate, sing out and we can run through that as well too. Okay, question here from Tristan. If looking at repatriating to Australia, is it true that your repatriated funds should arrive in Australia in the financial year prior to avoid tax implications, i.e. arrange for money to arrive in June and you physically arrive in July? Look, great question, Tristan. For some people, yes, for some people, no. And when I say that, it depends on your jurisdiction. So I know we look after a lot of Emirates pilots as clients, and they do have complications when they do have monies coming out of their end of service benefit and their pension as to their timing. If you are coming out of the United States, for example, that's another complicating matter, because what you do in the United States and what you do in Australia, if you're still deemed a US resident, will affect that as well too. So it's going to really come down to where you're located, your personal circumstances as to when you do it. From a pension fund point of view, you have 6 months to move that pension into Australia, and that won't be taxed. But as we know from all the changes, really the only pension that you can move to Australia that is classified as a foreign pension would be the UK pensions, and unless you're over the age of 55, you can't move them. So once again, I'd never like providing a not a straight answer, but it really depends on your circumstances. Question here from Christopher: do you think we'll see hyperinflation in Australia or USA? I wouldn't say hyperinflation, Christopher, and the reason I say that is, for a hyperinflation to occur, we have to see obviously a dramatic increase in the cost of goods based on the baskets they use to calculate inflation. My only concern is not hyperinflation, it's stagflation. So stagflation, for the folks out there, is when we see an increase in costs of goods. That's how we calculate inflation, but we don't see the commensurate economic growth as well too. So I don't think we'll see hyperinflation. I think more so stagflation is the one of concern, and stagflation will be dictated based on whether we see a V or a U or an L-shaped recovery. Question from Cheryl Lee: do you have options for basing an investment portfolio on ethical as well as financial criteria? Yeah, look, Cheryl Lee, in answer to the question, ESG, which is a bit of industry jargon, which is in a very layman's terms, ethical investing is a very big part of the whole market these days. Certainly from our point of view, we do have ethical portfolios that we use for clients, and we obviously strip out some of the key components to make it more ethical in nature. Unfortunately, for it to be a true ESG portfolio, you can't actually achieve that in Australia because our industry or our market is very much dictated by resources and banks, which aren't the two most ethically friendly companies. So, we do go some way to, providing ethical portfolios to clients who do require them, but I just will preface that, from an Australian point of view, it's not a full agenda and it's not available to be completed in full. Question here from Michelle, just on the recently announced 6-month moratorium on the eviction of tenants, would this also apply to current tenants with an existing lease that will end over the next few weeks? What would happen if the tenant can't pay the rent and the landlord decides not to renew the lease? Look, that's a good one, and that's going to be, what I was saying before, Michelle, was the devil within detail in the next couple of days when they do announce a lot of the framework behind these announcements. Right now we're virtually getting a 2-page press release with dot points. The devil is going to be in the detail. You would think that if the lease is up, they can't squat, is my honest answer, but watch this space. Question from Theodora here. Will the AED, with the AED dropping, how wise is it to buy into US ETFs? Look, it's an interesting one. There's a lot of debate behind it. To be honest with you, you are obviously buying, your cost of buying that US ETF is going to be more expensive because the Australian dollar has fallen, but also that US dollar ETF has fallen as well too. So let's say, for example, the Australian dollar has fallen 20% against the US dollar, but the US dollar ETF has fallen 30%, and that US dollar ETF rises by back to where it was before, then by most, if you ignore what the Australian dollar does in that period of time, then look, you've made money to make the exercise worthwhile. It really depends on your view on the Australian dollar. If it's going to be weaker for longer versus, say, the US dollar ETF you're investing in, there's a lot of moving parts there, and look, it depends on different people's circumstances in terms of their risk weighting and assets, but it is possible, and it is, certainly something we do for clients, but we do for clients knowing all the facts and knowing their risk profiles. Question from Jared here: in terms of investing platforms you use for investing for expats, how long does it take to set up an account with them, and will they do a broker-to-broker HIN transfer? From our point of view, we have to go through a process when we're recommending a client to set up an account. That process involves issuing a statement of advice, which is virtually saying, Mr. Smith, this is who you are as an investor, this is where you're located, this is your tax jurisdiction, this is your risk profile, this is the amount you want to invest, this is what you want to do. That document can take, between 2 and 4 weeks, depending on how busy we are. And then in terms of, if you're happy with that recommendation and would like us to go ahead with opening an account for you, the actual account opening process doesn't take very long at all. It can take 2 to 3 days. Unfortunately, we do have, because we are highly regulated, we do have some compliance reasons why we do have to go through to set up accounts for expats, and that's the reason why the platforms we work with allow us to set up accounts for non-residents, because we do go through what we go through. So in terms of the actual process itself, not very long, but we to set up the actual account, but it's actually, there is a regulatory process we have to go through in order to comply. Question from Lisa: will the banks, and in particular ANZ for them, also grant mortgage frees for expat customers? Lisa, this is what I was saying before about we do need to get on the front foot with this and talk to all the banks, and we will be doing that over the coming week. You would have to say yes, but banks are banks. So keep an eye on our website and social media channels. We will keep everyone informed as to what the banks tell us. So what we're going to do is virtually go bank to bank and find out the details. It's not going to be easy to get, so give us some time, but we are going to certainly find out more in the coming weeks, that's for sure. Question here from Richard: do the tax advantages of investment in shares you mentioned as compared with real estate depend on the tax system in your country of residence, which might, for example, levy tax on share dividends, etc., but not on property rent already taxed in Australia? Look, Richard, yeah, spot on. It depends on the country you're resident in, or depends on the double taxation between those two countries. So, more than happy to, provide you with more scope on that. And it also, if you're in the US, it depends on the state you're in, because the DTA doesn't extend to a state level either. So it really comes back to, those sort of things. To us, the big issue is going to be is most clients will tend to sell their Australian portfolio when they return to Australia, when they're tax resident in Australia, because when you land in Australia, you can sell that portfolio 3 months after you return back to Australia, at which point you're not a resident of another country from a reporting point of view. You're a tax resident in Australia, and you only pay capital gains tax on that 3 months you're back in Australia. So that's some way that clients, just give themselves a bit of peace of mind when it comes to that. Certainly on the dividend side, whether that country recognises franking credits or not will depend on your country of residence. But once again, horses for courses there, I'm afraid. Question from Jane here: you mentioned DTA of 15% for residents of the USA when talking about franking credits. What does DTA stand for? Sorry, DTA stands for Double Taxation Agreement. So I keep defaulting back into acronyms, but long story short, it's virtually an agreement between two countries. In our case, as an Australian citizen, Australia and the country you're resident in. And if there is a double taxation agreement, you can actually Google double taxation agreement between your country, type your country in, and type in Australia, and you'll see very quickly whether there is or not. Question from Sergio. Thanks, Brett. Webinar's amazing. Questions. If renters don't pay, are you able to make a claim under landlord insurance? Does this change with potential to get exemptions? Sergio, great question. We're seeing a lot of conversations going on right now with people who do have landlord insurance, and some do and some don't. So you will need to contact your individual provider. There's about 3 or 4 providers of landlord insurance in Australia, and see whether they do. Because look, it's something that it is evolving very, very quickly, and to be honest with you, they may not have the information yet. It's a question there from Daniel Stewart. Thank you. Okay, cheers. Christopher, are we able to compensate you for this call? I'm grateful for your time and expertise, mate. Look, we're just there for expats. You guys are our universe when it comes to what we're doing. As a former expat and a current expat, we live, eat and breathe the same thing you guys do, and we experience the same pain points you do. So certainly, we would love all Australian expats to become clients of ours, but we're not that greedy. But we know from what we're doing, there's a lot of information we can impart, education we can provide. So just absolutely happy to be there for you guys, because even ignoring COVID-19, it is difficult managing your finances as an expat. We get it. Add COVID-19, it's just at a magnitude of 10. So I guess we're doing this in our spare time in the background. and happy to do it. Obviously, our clients are first, you know, and during the working hours and extended after that, you know, we're looking after clients. But when we do get a window like this that we can be of help, we're always happy to do it. Buy me a beer sometimes. You know, there you go, Christopher. If you want to compensate me, just buy me a beer. Question from Matt. Haven't heard too much on the insurance companies and their risk exposure to the current situation. Do you see a majority of negative impacts similar to 9/11? Look, insurance companies is an interesting one. You know, we saw late last week one of the big providers, TAL in Australia, from a life insurance point of view, who had pandemic exclusions all through their insurance. They did a 180 and removed those exclusions. So I don't think we know the full effects yet from the insurers. I don't think we would know for probably 6 months, to tell you the truth, because there's so many different types of insurance that this may affect, like Sergio's question before with respect to landlord insurance or business continuity insurance. You know, what we're seeing right now, and we're seeing it here, and I'm sure everyone's seeing it there, there's so many more scams going on with people trying to take advantage of people in a difficult situation when the guards are down. So cybersecurity and insurance might go up. There's so many different ways, you know, where we see insurance that companies take out for trade, and if they can break a contract, you know, because of these circumstances. You know, there's that. You know, I don't think we understand the full effects yet. I think it's going to be different than 9/11 in terms of where the pain points are, but it could be on the same scale. Question from Karen. Thank you so much for your time. This is one of the best things info I've seen in a long time. Happy to help. I had my client meeting with James last night. He was fantastic. Fantastic. You know, James is the better looking one of us two that was in the photo earlier. You know, look, you know, we're just all about just giving you guys the best advice, and I'm glad that you had your call with James, because yeah, he's a legend, and proud to work with him. Question from Donna. Great webinar. The Q&A session was very informative. Thanks, Donna. Look, you know, our Q&A sessions are pretty much famous. They often go for 2 or 3 times longer than the actual session itself, because, yeah, we just want to be there for expats and provide you guys with as much information. So, yeah, definitely happy to help. Question from Ruchi. Will this Q&A be available online? Look, just to explain to everyone as well too, we're actually recording this live right now. And then what's going to happen is once it's finished, it will say it's going to, you know, it's been going for 2.5 hours now. So it will take a while for the system to do its thing. And then what we do is we actually email out a link. We upload this onto our YouTube channel, so you can go back to it as many times as you want. And what we'll do is email you a link to that YouTube channel. And yeah, you can watch it over and over again if you're really, really bored and don't have anything to do while you're working from home. So yeah, definitely from a Q&A point of view, it'll be all online for you guys. Question from Richie as well. If I transfer money to Oz, does it get taxed if it's over a certain threshold? No, not at all. You can transfer cash into Australia and leave it there. The question, the thing you got to be watch out for is, will that action jeopardize your tax residency status? So when we talk about tax residency status, we're talking about the 4 tests. The 4 tests are the resides test, the domicile test, the 183-day test, and also to the Commonwealth Super test. Resides test is pretty simple. Where do you live? Domicile is what catches most people up. The second test, you know, where is your domicile? And domicile is a very old ancient language that goes back into the 1800s and 1900s, and essentially, not ancient, anyway, ignore that. Long story short, the tax residency rules were written in 1936, and so all this phraseology was used then, not really applicable today, but the way that the ATO governs this is they look at your behaviours of your domicile. So if you were to transfer, say, I'll take an example of me being based in Dubai. As a non-tax resident of Dubai, my actions should map to that of an Emirati, you know, because I'm a resident of Dubai. Would an Emirati just transfer cash to Australia for no reason? No, they wouldn't. You know, would they transfer cash to buy a property or buy shares or pay down debt? Yes, they would. So, you know, it's not the actual transfer itself, it's the actions from that transfer which may jeopardise or may create issues regarding tax or not. So look, in a very roundabout sort of way, the transfer itself won't generate a tax, but it will, depending on what your actions are. Certainly if you did repatriate back to Australia and you left cash overseas, then, let's say, for example, you thought the currency is going to go better in the next 12 months, so you left it overseas and you transferred the cash back. Yes, that would create a capital gains event because the ATO says, look, you've been overseas, you've been back in Australia for long enough to repatriate your money, you left the money overseas to try and game the system and trying to gain some dollars in terms of that. So therefore, cash is an asset and you will pay capital gains tax on that. Question from Anna. Thank you very much for useful information, Becca. Happy. Great. Again, I'm just saying thank you. Someone should buy a case of Corona. Yes, please. And question from Ian. Great stuff, mate. Thanks for the info. Just on the tenants issue, what happens if they trash the place? Can they still be evicted? Yeah, look, great question. We've had that from a couple of clients. It's going to depend on what we see over the next couple of days, and sorry to sort of keep dodging the answers, but we just don't know until we see that sort of stuff. In the meantime, certainly hope you've got landlord insurance to cover you from that point of view. But certainly from the other point of view, definitely it's got to come down to both the landlord insurance and what the government announces in the next couple of days. So, right, guys, I think I've got to the bottom of the questions there. So if there's any other questions, you've got 30 seconds. Otherwise, I might wrap it up there. And, looks like it's fine. So look, guys, I'll wrap it up there. If you do have any questions, please jump on our website, atlaswealth.com. We produce a ton of content on there. We do, really try our hardest to keep expats informed. So please do jump on there if you have any questions. If you want to get in contact with us, by all means, probably the easiest way is just go to the Contact Us button on the website, or drop us an email at atlaswealth.com.au. So without any further ado, I think I'll wrap it up there. My voice is almost completely gone. So, I dare say how this is playing out right now, we may actually run another one of these. So keep an eye on your emails. If things change quickly and change a lot from what I've discussed about today, then look, we're more than happy to jump online and do this again. So stay safe, guys. Wash your hands. Make sure you have your showers and look after yourself, and look forward to talking to everyone soon. Thank you, guys. Take care.